Oscana? Not yet. Power Lawrence.
Here.
Dan, Post.
Here.
Lizette?
Here.
Hannah? Hannah's not here. Oksana, did you just sign in? Yes. Okay, sign in. Hannah's not here.
I'm here.
Oh,
Oksana.
Hannah, you're here?
No, this is Oksana.
Okay, thank you. All right, so I don't think Hannah's here yet. All right, so we'll get started. I'm going to get started with the practice quiz. I trust that everybody went over it before today's session. So I sent that to you last week. Told you guys to work on it over the weekend. We're going to do it today. Okay, hold on. I'm pretty straightforward with this one. Did find my calculator finally. Okay, so again, the first one is asking compute taxable income for a single taxpayer with. Oh, by the way, I'm not going to save this document or post it on Brightspace. You should take notes, or you could actually annotate it and save it from your end as well. So again, make any notations from your end. Any notations that I make, I will not save to Brightspace. You would have to make those notes on your own. All right, so for the first one, we're asking for taxable income for a single taxpayer salary. Oh, Hannah, there she is. All right, so salary, that's taxable, right? 25,000, right? Interest bonds, is that income? Interest from Illinois bonds, is that income?
No.
No, it's not.
No.
Well, it is income, but it's excluded income.
Okay.
It's
You know
not
what?
taxable, but it is income.
But it's not income. Okay, I see what you mean. For the purpose of when by the way, that's actually a good. You're right, but you're not. But you're right. You're right. It is
This is
income.
kind of what I was hoping to talk about earlier.
But keep in mind that this is a tax class. When we're focused in the world of tax, when I'm asking if something is income, what is the question that I'm asking for? Is it gross income?
Is it taxable
Is it
income?
taxable? Yeah, that's the question that I'm asking for. You're absolutely right. Everything is considered income. You're right, unless there's an exclusion that tells you otherwise. But you're right in starting to think that way. Every interest amount is income. Is this excluded from gross income? Yes. So this is like you when I'm asking for gross income, it's everything. It's included in gross income minus what's not included. So I'm not going to include it. So if I'm asking for gross income, remember that's the starting point of the formula. Figure out what's gross income. Does that include interest bond? I guess that's the question. If you want to just put it as simple as that. I'm asking for gross income, then I'm asking for adjusted gross income, then I'm asking for taxable income. Starting from the first point, gross income, is interest from Illinois bonds included in gross income? No, right? So then we skip that. That's excluded. Of course, if I'm asking you to make a note, you would state that municipal bond interest is excluded. Corporate bond or corporate dividends, that's income,
Yes.
right? So corporate dividends, I'll abbreviate dividends. That's 200, right? Anything else? That's it, right? So total gross income. So the question here, the total gross income would be what? What would be total gross income in this case? I don't have a calculator.
25,200.
Okay, yeah, 25,200. What's the next step? Once after this?
The adjusted gross income?
Yeah, now we got to figure out adjusted gross income. Again, that's what we're focusing on. What's gross income, then adjusted gross income, So we need deductions, and I'm going to abbreviate for AGI, adjusted gross income. And there's only one, right? Traditional IRA contributions. So that is 3,000, right? So again, I'm going to abbreviate. So your adjusted gross income is how much? 20, what? 22,200, right? My math is correct. As far as what's the difference between a traditional IRA and a Roth IRA? Anybody know?
One goes in tax-free, one gets taxed.
There's that, and it's also you're capped on how much you can put into a traditional IRA.
Well, you're capping both.
Yeah, you're captain.
Yeah, but the cap is earlier for the. Or you should maximize your traditional IRA before your Roth IRA.
Well, you can do that, but the main difference, I heard a couple of you guys say pre-tax, no tax, tax-free. The way it works, it's as simple as this. You know what a 401k is, right? That's deferred compensation. So let's say, for example, let's say this guy's salary is actually $30,000, of which $5,000 goes into his 401k. That's how you came up with the salary of $25,000. That income is deferred, not excluded. It's deferred. Do you understand that, right? It's deferred income. So what does that mean? Since I'm putting $5,000 away from my salary into my retirement account, I'm deferring it until the future. So the $5,000 that I'm putting away right now into my 401k, I'm going to pay taxes on it later in the future. You know, I guess you're expected to be at a lower tax bracket when you retire, but that's the idea between deferred compensation. Money you put aside today, it's not tax free. It reduces your taxable income in that respect, but you're paying taxes on it later. Same thing happens with a traditional IRA. So this person is putting $3,000 into a traditional IRA. Is that tax free? No, you get a deduction right now for putting it in, but when you take it out in the future, that's taxable income. That's considered income. Roth IRAs, it's totally different. Roth IRAs, any money that you put in now, you don't get a deduction for it. But when you take it out, assuming it's a qualified distribution, it's not income in the future. One of the things I want you to, try to stay away from saying pre-tax, after tax, because that's not exactly how it works. It's pretty as simple as this. You take a deduction today, you recover it in the future, it's income. You don't take a deduction today, you recover it in the future, it's not income. It's as simple as that. One of the things that we're going to cover in more detail a little bit later, it's called the tax benefit rule, and that's how it works. You get a deduction today, you recover it in the future, it's income in the future. Traditional IRAs, 401ks are pretty much built around the same concept. You take a deduction today, when you take it out, it's income in the future. Whereas a Roth IRA, you don't get a deduction today. When you take it out in the future, it's not income. But one thing I do want to say about that, it's not income now. Keep in mind that Congress can change their mind anytime they see fit. That has happened. Now, what's the next step? Standard deduction or itemized deduction? Standard?
Standard. Yeah.
Standard deduction. So wait, I want to put the parentheses 12,200. Hey, I don't need a calculator for this. Did you guys get taxable income of what? 10,000?
10,000.
Yes. Yeah.
You guys agree with that?
Yes.
Yes.
Any questions on that part? No questions on what's income, what's deductions from AGI? Keep in mind, the only thing that we're deducting from AGI, we're going to get into more detail today. Remember, deductions above the line, this is your line, adjusted gross income. Deductions above the line, like traditional IRAs, any losses that are deductible above the line, those are deductions for AGI. Deduction from AGI, again, here's your line, AGI, are deductions after adjusted gross income. There's only mainly two types of deductions from AGI. standard deduction and itemized deduction. Those are the only two types of deductions from ATI. There used to be personal exemptions, but that's been temporarily suspended until 2025. Actually, I lied. There's another deduction available from AGI, and that's a deduction for qualified business income. But for most taxpayers, it's just a standard deduction or itemized deduction. That's the only thing they're deducting from AGI. Again, this is pretty, straightforward. No questions on number one? Okay. Number two, what is the filing status for the taxpayer who has a qualifying dependent living with him or her for more than half the year? What do you think? What do you guys think?
Head of household?
Head of
Head
household.
Head of household.
House. All right. Number three, what is the filing status of a taxpayer who was married the whole year but was divorced on December 31st? Just on those facts alone, what is this person's filing status?
Single?
Single or head of household? It
No, just on
depends.
these facts alone.
Single.
Then
Does-
single.
Yes, you can't, and that, again, that's good that you start seeing what's available, but again, you always go based on the facts given. Just on these facts alone, this person is single. It doesn't mention anything about any dependent or anything like that. I guess in practice, you will ask, do you have any qualifying dependents? Then in that case, head of household may work, depending on the circumstances. But again, this would be a very interesting situation, because what if this person was married? Actually, let's talk about that. Let's say this person was married for the whole year. What would be the filing status to be considered head of household? This person would have to be a single parent, so the dependent would have to live with him or her for more than 6 months, for the last 6 months, right? That's the only way head of household would actually work. So you would ask additional questions to see if that actually qualifies. But again, just based on these facts, just single. That's what we're looking at, single taxpayer. And by the way, um, just because somebody has a child does not mean they qualify for head of household. Just keep that in mind. There are individuals that are single and still claim dependents, but they're not considered head of household. They may be entitled for some of the credits, but they're not considered the head of household because they're not actually head of the household. Head of household, you got to provide more than 50% of the cost of maintaining that home. That's the whole definition of being head of household. So don't automatically assume that single parents, for the most part, are head of household, but not all single parents are head of household. All right, number four. Which federal trial courts require payment of tax prior to petitioning? There's two. What are
U.S. District Court and the Court of Federal Claims.
they? U.S. District, good. U.S. District Court and U.S. Court of Federal Claims.
Actually, you said trial courts when you spoke it out loud. I was wondering, are you required to, if you do tax court, but then you want to file an appeal, are you required to pay what they think you owe before you go to appeal?
No, you're not required. That's something we covered the first week.
That's what I thought. It was just a slight distinction. So
Yeah, that's
like, in theory, like sometimes you're required in the appellate court to pay your taxes ahead of time, and sometimes you aren't.
Well, not the U.S. tax court. The U.S. tax court, the only requirement is that you petition within 90 days of the. Oh yeah, keep it for the U.S. tax court. I think that's one of the questions later. You got to petition within 90 days of receiving that statutory notice of deficiency. Period. Period with that. With the U.S. District Court, U.S. Court of Federal Claims, again, you would pay the tax first, sue the government for the money, and then recover it. That way. That's how that would work.
How much time do you have to file with these two courts other than the U.S. tax?
Well, you're not limited to the 90-day window. So that's the key difference between the two. You're not limited to the 90-day window. I guess within a reasonable amount, time frame. Of course, you're not going to take 2 years to file a petition in U.S. District Court or U.S. Court of Federal Claims, but you're not limited to the 90 days. I guess that would vary by district because each district would do it differently. But it's not as limited as the U.S. tax court. But again, within a reasonable time frame. So so going back, let's say you get audited, you got your statutory notice of deficiency. Once you get that notice of deficiency, then you think, okay, should I go to tax court? Should I go to district court? Those are usually your two options. Of course, you could also take it to U.S. Court of Federal Claims, but very few cases even get brought in there. But in terms of district court and U.S. Tax court, that's when you have to, ask yourself: is this a technical issue that you believe that you will win on its merits? Go to tax court. You don't have to pay the tax first, so long as you petition within 90 days. Or the other option is, go to district court. And keep in mind, when you go to district court, it's actually a longer process because once you get the statutory notice of deficiency, you got to request a refund from the IRS. You got to wait for them to deny that refund. Then you petition within, well, there's really no time period from that point. But it doesn't start from the statutory notice of deficiency. You get the statutory notice of deficiency, you pay the tax first, then you ask the IRS for the money back. They're going to say no, and then after you receive that letter denying that they're going to get you your money back, the request a refund, then you petition. That's going to be your proof of why you're suing the government for the money. You paid a tax that you believe that you should be able to recover that, and that's why you're suing the government for the money. And that's for district court and U.S. Court of Federal Claims. So that's the process between the two. Where U.S. tax court, it's just you're suing them for you're suing the government, but you're not suing it for the money. You're suing them out for tax law, I guess, on its merits, but you're not required to pay it. Dependency test for qualifying relative. I'm going to put it on the next page. Qualifying relative. So this is gross income is less than exemption amount, right?
Yes.
Support by taxpayer is more than 50%. And the last one is relationship or member of household for a whole year, right? That's it. It's it for the dependency test for qualifying relative.
How about citizenship? Will it be included?
I guess that's a good question. Well, I guess is citizenship required? No, it's not. It's not required. But in terms of getting it's never been required actually. The requirement used to be again prior to the Tax Cuts and Jobs Act. It was if you're a citizen or a resident of the United States, Canada, or Mexico. And keep in mind that you could be still considered a United States resident even though you're not a permanent resident. But for tax law, you can still be considered a resident alien for tax purposes, as opposed to a permanent resident. But that's something that, a little bit different than what we're going to get into. But in terms of citizenship, it's not required. But what I will want you to understand is that credit for other dependent or the child tax credit, what's the requirement for both? Not that they're a citizen, that they have to live in the United States, right? That's the requirement for both. They have to live in the United States. So it's the residence requirement. Now, I guess the requirement for child tax credit, again, it doesn't explicitly state that it has to be a citizen, but the child tax credit must have what? A social security number, right? So for the child tax credit, the credit for a child under the age of 17, that dependent has to have a social security number, but it doesn't explicitly state that they have to be a citizen. So just keep that in mind.
How about if that child doesn't have a social security number, it has an ITIN number?
Then they don't get the child tax credit.
Oh, okay.
Yeah, they don't get the child. They may be able to get the credit for other dependent, but they don't get the child tax credit. Because again, the child tax credit is specific now. It's required to have a social security number. But yeah, again, somebody just said it. A social security number, you can still get a social security number if you have a permanent residency card. You'll get a social security number. Again, you're not a citizen yet. It's a pathway there, but you're not a citizen yet. But as long as you have a social security number, the dependent that is can get the child tax credit. Short of that, it's a credit for other dependent, the $500 credit. Number 6. Or any other questions on dependents? Okay, number 6, the types of examinations. What do we have?
Field, office, correspondence.
Yeah, correspondence, office, field. That's it. Very good. When you think of a kid, what do you think of? Ras. Relationship. Now age. Now the age is under 19 or under 24 and full-time student. Right? Self-support. The dependent does not support himself or herself. And home tests. Temporary absences. There are some exceptions for temporary absences for school and for military.
So for
If
these,
you're incarcerated, you can't claim your dependent as incarcerated.
quick question. So for the self-support rule, it's that the dependent does not provide 50% or more of their own self-support,
Right,
but there's nothing in there that the taxpayer has to be supporting them.
right.
Okay, that's what I thought.
Yeah, that's it. That's as simple as that. Yeah, because again, it's because the part with this, it got very tricky around this time. Again, this is part of the where they bifurcated the two rules. Before it was the taxpayer has to provide over 50% support. But what about those parents or those couples or the where they have a dependent and it's equal support? That's possible, right? So in that and under the old tax law, I guess one of the flaws was well then nobody gets a dependent because it would be on the taxpayer who provides over more than 50% support, or collectively the multiple support agreement collectively more than 50% support anyone more than 10%. So that was I guess one of the flaws there. And then they sort of took out these rules, they carved out these rules, and they created this for qualifying child. As long as the dependent does not support himself or herself, and then the other tests are met, yeah, that qualifies. But even with this one, self-support, yeah, you're right. It doesn't say that the taxpayer has to provide support. But this is more like, is the dependent, another thing you have to ask, is the dependent independent? So let's say that the dependent, is going to school, and it's a full-time student, but has a full-time job and made $30,000, or even made, let's say, 20,000, whatever the amount is, $30,000, doesn't matter in this case. This person lives on his own or her own, have their own apartment, pays for his or her own apartment and all the other expenses. Does this dependent provide more than 50% of his or her own support? All the other tests may be met. Relationship, the taxpayer is related to the dependent. The age test, again, he's a full-time student, and this person is 22, so that's met. Here's where it comes in: $20,000. He's paying his own bills, or she's paying her own bills. Then that self-support test will not be met. So something else that to think about, if they're trying to claim a dependent who lives outside of the household, you do have to ask additional questions. Is that person, is I guess you will. Another way around it would be, I guess you will ask, are you supporting the dependent? I guess, but you're right. But that's not even part of the law.
Yeah, because
But
what I was thinking of the kind of a situation is both the parent and the child are staying with a family friend, and the family friend is supporting uh, the the student, we'll say, for the most part, and the parent isn't providing anything, but they're still in the same house, they're still related, they're still a full-time student under 24, and the student isn't supporting themselves. Under that system, it seems like the parent who's living in the same household would still get the tax credit under this rule.
yeah, I guess if yeah, that's actually that's a pretty common situation. That the way that you explained it, that's a very common situation. So the situation is so the parent of the taxpayer, uh, she or he's providing all the support of oh, so actually let's go with that. Actually, I'm glad that you gave me that scenario. Who would be head of household in this case? Not the mom or the father, right? Right? But but in that case, the taxpayer is still entitled to claim the dependent. Everybody in agreement with that, right? Okay, everybody in agreement with that. So the taxpayer still claims a dependent. Either in this case, it will be the $500 credit if or you know, assuming they're between 19 and 23, then it will be the $500 credit. So everybody in agreement that, you know, the dependent goes to the taxpayer. What is the taxpayer's filing status? It would have to be single, because she doesn't qualify, or he doesn't qualify for head of household, because he or she is not the head of household. Was that you, Matthew, that gave me that example? Okay, so in that case, so the father or the mom is paying the bills. Is he or she entitled for head of household?
Not in that case, no.
Well, what do you? Well, why not in that case?
Well, I mean, I thought, well, yeah, that's a weird question then.
Yeah, that's a weird question. Because you need additional facts and circumstances. You know, it may work. It may work. Even here's another thing to consider for head of household. Usually, to be head of household, you do have to claim a dependent. But there are, you know, rare situations, and this may be one. I'm not saying it is one, but this may be one where I guess the grandparent, you know, the taxpayer's mom or taxpayer's father, he or she may be head of household and not claim either one of them, but still be able to claim head of household. Again, it's a very rare situation, but again, facts and circumstances, that may actually still work against facts and circumstances, or none of them get head of household. You know, so just something to, you know, think about. But again, the parent, the first parent, the parent of the child, that person does not get head of household, because she or she, I mean, based on the facts given, they're not paying any of the bills, or at least more than 50% of the bills. So something like that, I guess you will have to dig around and ask additional questions. But if the only one you were representing, let's say you were only doing the tax return for the you know, the first parent, the taxpayer, and then you're only limited to that. You can't really investigate, well, what about your dad? What's his filing status? Unless you were doing his or her tax return, then then you should give advice. But your advice should be just limited to the taxpayer you're representing. So in this case, it'll be single taxpayer, possibly the $500 credit, because in this case, it's the self-support. And even taking it a step further, you know, keep in mind under the tiebreaker rules, it does go to the parent first anyway. The legislative process for laws, we start with House Ways and Means. Abbreviate. Then it goes where? House of Reps. Well, then it goes where? Anybody? Senate Finance, right? Senate, right? And then President. What happens if Senate and House have different bills?
It goes to the joint Senate and House committee, and then it's re-voted on by
Well,
both House and Senate.
it goes to joint conference. Let's just say joint conference committee on taxation. But it is, yeah, it's yeah, they reconcile two bills. So Senate and actually it has to go to House first. House and Senate can vote. So yeah, that's true. The joint conference committee, or anytime you hear it, it goes to joint conference or conference. That's what they're referring to. And you may hear this a lot if you follow politics, if you're watching C-SPAN or whatever news channel, and they're talking about the bills in conference. That's what they mean. It's in joint conference. They're trying to reconcile conflicting bills that the House and Senate have, and then it goes back to the House and back to the Senate for vote. Oh, here's the other one. Number 9. There's only one question answer here. U.S. tax court. Hey, U.S. tax court. Primary sources of tax law. We got statutory, right? Statutory, we got Internal Revenue Code, 16th Amendment, right? Treaties. And then we got administrative. What do we have under administrative? Treasury regs, right? I'm gonna abbreviate. Actually, no, I'm not. What else? Anybody?
Revenue procedures.
Revenue procedures, revenue rulings. Can't even spell today. Private letter rulings. I say that's it for now. Well, there is the termination letter, but those are taxpayer specific. I'll leave that one out. Did I get any? Did I miss anything? No, I didn't miss anything. Did I? I think I got everything. What's next? Judicial. So that's the judicial. That's case law. Anything, even the appellate courts. Briefly describe the statute of limitations for assessments. So that's audit. So assessment, audit, it's what? Later of, remember, keep that in mind. It's the later of, actually, let's start it out this way. 3 years from later of filing date or due date. So again, if they file before the due date, then it starts on the due date. If they file it after the due date, then it starts after the due date, right? Exception if TP omits more than 25% of, I'm going to abbreviate GI, then it is 6 years, right? Is there no year or no statute, no limitation, no?
Fraud.
Yeah, no limit.
Or failure to file.
Yeah, fraud or failure to file. Wesley Snipes was guilty on both cases. He forgot to file, and then he filed returns, 0 returns. Like seriously, he filed a 0 return. I'm not lying. I wish that was funny, but it's not. What? Did he put 0 returns? Well, yeah, but then he also blamed it on the accountant later. Oh, speaking of which, I don't mean to go on a tangent, but it's related to this particular subject. There's a lot of tax protesters. I'm sure you've heard of some of these arguments. I want you to, in your own time, go to the IRS website, look for 30 dozen, search for 30 dozen, and that gives you a list of tax frauds, and not just frauds of the ones we're talking about. It talks about phishing scams. It talks about identity theft scams. It also has a particular section on tax protesters. These arguments, they're all over the place. There's an argument that it only applies to corporate income tax, only applies to corporations, and they're not. I don't know, some convoluted argument that never held any water. One, that the 16th Amendment was not properly ratified. That's a common argument. Filing a tax return, it goes against my Fifth Amendment rights. Again, Fifth Amendment means the right not to incriminate yourself. Yeah, people have argued that several times, that it goes against the Fifth Amendment rights. What else? I mean, the list goes on and on, but there's like so many of them. Here's one. Where in the Constitution, and this is a pretty basic one, where in the Constitution does it say that I have to pay taxes? 16th Amendment. That's pretty, clear. And then, the code itself, it's Section 1 of the Internal Revenue Code. It's all there. Wesley Snipes followed those tax protesters. And one argument was, when you're filing a tax return, you got to attach a statement that you're filing this tax return process. And he actually did that. And on the tax return, he actually put zeros all down the tax return. Again, that was part of the argument, because there's no income, because he's not a citizen as it's defined only by corporations. It's some weird argument. He lost, by the way. The other issue was he didn't file tax returns for a couple years, which that was pretty basic. He lost on that as well. He ended up doing 2 years on, I don't even know if he did the full 2 years, but he's out already. Um, so after, he got out of jail, he tried to submit an offering compromise. That was the funny part. Let me tell you again. He tried to submit an offering compromise. I guess maybe that's not, so funny, but remember how I talked about these settlements in terms of offering compromise? That's usually geared towards people that are broke. They're and the offering compromise, it's you have three options: either doubt to collectability, doubt to liability, or it's administrative effective tax administration. The more common one is doubt to collectability, meaning there's doubt that the IRS is going to collect the full amount. That was his argument. That keep in mind, this guy's an actor. His argument was that his earning potential now and in the future will not be enough to pay his tax bill plus all these penalties and interest. Okay, granted, that's possible, but part of the offer and compromise process, you got to submit documentation, supporting documentation that shows that why there's a doubt to liability. He failed to disclose all his information, so they just rejected it just on that. And they do that on procedurally. Anytime you don't submit 100% of your documentation, they can reject the offer just on that. If you don't submit your documentation, again, they're asking for bank statement, they're asking for financials. If you don't submit that, if you just submit the actual form with very limited information, it's going to get rejected. And that's what happened with him. He lost in the it didn't go to tax court. It actually went to district court. He lost in district court, and then he did time, and then he lost in terms of the offering compromise. So the lesson here is, he also blamed his accountant as part of the process. That's why he owed a lot of money. It wasn't his fault. It was his accountant's fault. Imagine that. All right, for refund. Refund, it's generally 3 years from later of filing date or due date, right? Limited to 2 years after taxes are paid. There are some exceptions. We're not going to talk about it yet. Maybe we'll get to a little bit today for NOLs. What are NOLs? Net operating losses. We may not we'll get into net operating losses Wednesday for sure. I may talk a little bit about that, but those are business losses. So I may talk a little bit about that today. Oh, we're missing one. What's the next one? Collection is 10 years from assessment date, right? So it's either due date, wait, due date / filing date, right? Or statutory deficiency notice date. Again, if they got audited, it starts with the statutory notice deficiency date. If it's just filing the return, it starts when they file it, or after, if they file it after the due date. That's it. No more questions. I thought I had more questions. This quiz was too easy. What do you guys think? Too easy, right? Yes? Was this quiz too easy?
It wasn't bad.
Now, in terms of how I'm going to ask you, it's not just it's not going to be in this format. It's going to be a multiple choice questions, and it's going to be whatever I cover up until the end of class today. So that includes all this stuff. There's the computation question, at least for the first quiz, is going to be as simple as this. You may need a calculator, but it's something like this. But again, you gotta pretty simple computations, itemized deduction, standard deduction, gross income and stuff like that. Now, as far as the filing status questions and exemptions, those questions are going to be facts. I'm going to give you facts, and the facts are going to be, what's the filing status for this person? What is the best filing status for this person under tax law? And that's what we're going to pick with. And then for the tax court questions are pretty similar to this, appellate court. And again, same thing for dependent credits. Again, I give you fact patterns. You tell me filing status and is it a qualifying dependent? Um, Again, legislative process, pretty straightforward. 16th Amendment, primary source of tax law, pretty straightforward. And the statute limitation, that's going to be facts. So if I tell you somebody filed, let's say I tell you somebody filed a tax return June 15, 2020, ignoring the extended due date, never mind the extended due date as part of the CARES Act and previous and other guidance. Normal tax year, again, 2020, there was no extension. Coronavirus didn't happen. This person filed a tax return June 15th. The due date was April 15th. So then the statute would start June 15th. So it'll be 3 years after that date, June 15th. And that's how the statute of limitations starts. Again, that's how I'm going to give you the facts. So just keep that in mind. That would be it for that one. Any questions? Anything you want to ask me on this? No questions at all? Wow. So that means everybody's going to get an A, right? All right, the quiz is going to be available. It's going to be available starting tomorrow. Wait, yeah, tomorrow. Starting tomorrow at midnight. So you can actually take it like overnight, not go to sleep and still take it. The latest you could take it would be up until again, it's 30-minute time quiz. So the latest you can take it or start taking it would be 5 o'clock tomorrow, or not tomorrow, 5 p.m. on Wednesday, because it would have to be submitted by 5:30. Everything has to be completed by 5:30. At the beginning of Wednesday's class, we'll do the same thing. We'll go over the quiz and go over the answers. And then I'm going to release the answers after we go over the quiz questions on Wednesday. So that's going to be Wednesday session. And then we're going to cover more material. So did you guys notice that I posted a lot of stuff? You guys notice that? So I got all the lecture notes for the rest of the semester. It says it's everything, including what we're going to cover today: gross income inclusion and exclusions. Wait. We're going to talk about, actually, we finished the exclusion section. I mean, the inclusion section. There are a couple questions that I want to go over, including the chapter 3 question. But I want to talk about exclusions in more detail. And then we'll get into the question, more questions. Hold on. All right. So again, this one is gross income exclusions. It's an extension of what we covered previously. Again, so it starts off with, again, everything is considered gross income, except if it's excluded from gross income. But here's a partial list of what's income, by the way: compensation for services, dividends, interest, gains from the sale of property, rents, alimony, annuities, jury duty, prizes and awards, and any discharge of indebtedness. So if you have let's say you owe a credit card, let's say $5,000. The credit card wants their money, and you can only pay them $1,000. Again, you owe the credit card company $5,000. You negotiated with them to pay them only $1,000. They forgave $4,000, right? The $4,000 is considered income. The $4,000, that's canceled indebtedness or discharge of indebtedness. That's considered income in your hand. And that's you'll get a 1099-C that shows the amount that's considered income. There are some exceptions to that as well. But as far as this is just a partial list. And I'm giving you another partial list of income or items that are excluded from gross income. Again, this is just a partial list. Remember I told you section 101 through 140, that gives you the exclusions. A lot of them are found there. Not all there, but there are partial lists in here. Death benefits exclusion. We'll talk about that in a few minutes. Somebody passes away, you collect life insurance proceeds. That's generally excluded. You receive something as a gift, or you inherited something. Generally, well, actually, not generally. That part is excluded. Municipal bond interest, that's excluded from gross income. We're going to talk about compensation for injury, section 104. Like when you sue somebody, you get some recoveries. What happens there? Workers' compensation. What happens in that circumstance? We're also going to talk about accidental plans. If you get some kind of recovery from an accidental disability plan, is it income or not? When do we exclude it? Discharge of indebtedness, as I mentioned, it's included in income, except when section 108 tells you it's not included as income. So again, this is how it works. These are your exclusions. These are the amounts that tell you it's excluded from gross income. So what happens in a landlord arrangement where the lessor, the landlord, has a lessee, and the lessee takes it upon himself or herself to make improvements on that property. So we'll talk about that as well. When is it included? When is it excluded? The recovery of tax benefit, again, I'll talk a lot about that. The recovery of tax benefit, that works in a lot of circumstances. You take a deduction today, you recover it in the future, it's income when you recover it. Combat zone compensation. Pretty straightforward. If this is for military personnel, if they're at war, it should be excluded. The compensation that's attributed to the time that they're at war, that's considered that is excluded from gross income. I'm not going to talk about that particular portion because that's already handled in the HR side. Scholarships, we'll talk about that. Meals and lodging, we'll talk about that. Sale of personal residence, I'm not going to include it here. That's going to be covered. I'll talk a little bit about it. But this is what happened in section 121. When you sell your personal residence, you may be entitled to exclude a portion of the gain as long as it's a personal residence. I'm going to cover this in more detail when we cover property transactions towards the end of the semester, because that's more consistent with property transaction. What I will tell you here is you got to meet a use and own test. In order to exclude the gain, you have to live in a house for 2 years and own it for 2 years out of the last 5 years that you sell the property. So 2 out of the last 5 years. The excluded gain is up to $500,000 or $250,000 for single taxpayers. That's the amount under section 121. Again, we'll get into more detail when we cover property transactions. Cafeteria plans, those are some fringe benefits that we're going to talk about. Generally, it's excluded for the most part. Tuition reimbursement, we'll talk about that. Dependent care assistance, we'll talk about that. Personal injury, section 130 and section 106 are tied into each other. Because again, that relates to compensation. So most of the time they cover both sections together. Fringe benefits, we'll talk about that. One thing that I'm not going to get into detail, but I do want you to know that it's there. Remember I said that U.S. bond interest is considered income pretty much always, except when they use the insurance bond proceeds to pay off higher education expenses. Now, for this to work, this would have to be, and these Series EE bonds. These type of bonds are not really that popular anymore. But the Series EE bonds, I guess think of it this way, education exclusion. Actually, I really don't know if that's what their thinking was between that. You still have, you have some series. Oh, okay. Yeah. Well, for this one, well, if you're paying off the loans, then it doesn't go to. It would have to be education expenses. So it would be, yeah, direct. Yeah, it would have to be paid directly to tuition, but it won't be loans. It won't work on loans. So what you're trying to do, you're trying to refinance with bonds. Yeah, it won't work that way. In that case, it would have been better if you would have, cashed out. They would have to be Series EE bonds, cash those out, and then pay for your education that way instead of yeah. That would have been the better way. But again, you would have to file it. There's a separate form for that. I haven't done one of these in a while, but there's a separate form for that that you would have to attach with the tax return because you'll still get a 1099 for the interest portion, but you're telling the IRS we're excluding it because I'm using it for education. Uh, but yeah, that's yeah, it is there. It's yeah. Well, now you know. All right, let's go on to next section. Now we're going to details of specific gross income exclusions. Again, the first one, Section 101, that talks about life insurance proceeds. This is the death benefit rule. So the general rule, proceeds from life insurance plans are excluded from gross income to the recipient. Now, here's the exception. If the recipient has an option to receive either a lump sum payment, which is excluded, or receive multiple periodic payments, the earnings is income. Here, let me give you an option. So here's an example. Again, by the way, I'm not going to share this particular example, so you're going to have to type this example or write it down. So here's an example. Will either receive, let's say, $100,000 in lump sum or $15,000 per year for the next 10 years. So what happens if I'm a uh, I'm a apps for lump sum, no income, no gross income. Pretty straightforward, right? But what happens if I'm a apps for annual payments? $5,000 is income per year. How did I get to $5,000? The basis, remember, under the recovery of capital doctrine, you get to recover the basis tax-free. So the $100,000, that's just the basis or the recovery of capital doctrine. So keep that in mind. And when we're going to cover property transaction, it's always going to be the difference between what you're going to receive and your basis. So think about it this: if the basis is $100,000 and they're going to receive $100,000, there's no earnings, right? Taxable income is zero. But what if they're receiving $15,000 per year for 10 years? How much are they receiving? Actually, I got to put a couple brackets here. So it's going to be $150,000, right? Right? Minus $100,000. Let me. Okay, you guys see that portion, right? $150,000, that's $15,000 for 10 years. If my math is correct, what does that equal? That equals $150,000, right? And then divided by 10, that equals the $5,000, right? So you're recovering tax-free, if you want to look at it this way, $10,000 tax-free per year. Again, your basis is $100,000 divided by 10, you're recovering $10,000 tax-free. So $5,000, that represents your earnings. So the $5,000 is considered income in that case. Again, that's very common scenario where they have either one. Again, think of the tax consequences in that respect. Now, the other thing about life insurance, and this works for life insurance plans. If I'm sure you know the difference between term life insurance and which is the fixed benefit. You have a fixed amount; it's only going to cover for $500,000. You pay the premium or $200,000, whatever it is. You pay the premium. The premiums may be indexed or not, but you pay the premiums for 20 years, and then you're covered. At the end of 20 years, you can renew it or not. If you renew it, then you get it for another 20 years. That's how term life insurance works. They're expecting you to die or live within that term period. Whole life or increasing benefit type of plans, the benefit or the cash value increases. Now, I'm sure you heard about these type of plans. The cash value increases. Now, a lot of times you probably heard somebody say the cash value is tax free. No, it isn't. It isn't tax free. I want you to think about this for a second. Anytime when somebody says that it's cash free, look at the fine print because there's usually fine print in there. This is just an advertisement. This does not constitute any legal or tax advice, something along that line, because they're not qualified to give you tax advice. It's not tax free, more like tax deferred in a case. It'll be tax free if you pay it back. Because again, the cash value, so if you borrow against that cash value, you got to pay it back. If you don't pay it back, then it's considered income. But let's say you borrow against or you take that cash value and you cancel your plan. Then the difference, it's like you sold. If you think about it, you sold that the life insurance plan. The difference between the surrender value, which is your cash value, and your basis, that's considered income to you. That's considered income to you. There's really no exception to that. That's considered income to you. Again, your basis is generally that's your cost basis. Your premiums are tied into there, and then your cash value, that's the excess amount of what it's worth. When you cancel it, it becomes income to you when you cancel it. There's an exception to that. The exception to that is when there's for terminally ill taxpayers. This is what's called accelerated death benefits. That's when the exclusion comes in. It does you are able to cash it out, and that's not income. Most of it shouldn't be considered income, but you have to be considered terminally ill in order to be able to deduct to withdraw it for cash value. Gifts and inheritance. Now, one thing about this. uh, That's common. Well, that's very common. Well, the thing in that situation is not recognized yet until she cancels it. That yeah, no, until the policy was canceled. Yeah, until the policy is canceled. Yeah, that would be when it would be considered income because the policy is canceled. I guess let me give you another scenario. Um, and let me give you another scenario. A 401ks. 401ks, a lot of 401ks or 457s, 401(k), whatever type of retirement plans you have, mostly 401ks, have an option where you can borrow against your 401k, and the 401k is used as collateral. And then the employer will say something like, well, you got to pay us back. We'll take it out of your paycheck, X amount per week. Usually works. And that's a good option. Again, if you're rather than take the money out of your 401k, I would consider borrowing against your 401k or IRA instead of taking it out. That's usually the better option because that it's not a taxable event in itself. When you're borrowing against something that they're using for collateral, that's not a taxable event. But let's say something happens. I borrow against my 401k. My employment gets terminated either by me or by my employer. It doesn't matter, but it gets terminated. I would have to make an arrangement with my employer to still pay that loan back. If I don't pay that loan back, what's going to happen in that circumstance? Similar to your situation. Well, if I don't have an arrangement with my employer, they're gonna take it out of the 401k. When they take it out of the 401k to apply it against the loan, what do you think happens there in that case? It's similar to in this respect, but in this respect, because I left work, they're going to take it out of my 401k. That amount, the amount that's covering my outstanding loan, that's considered a taxable distribution to me. Similar situation to the one you explained, but the triggering event is I got terminated. I didn't I didn't enter into any future agreement with my employer for it to be considered for it to be triggered a taxable event. In this circumstance, again, it's pretty common if they're taking it out of the cash value. That's fine. as long as the policy is not canceled, again, if it becomes canceled, then it triggers a taxable event. Same situation in my job. Because my job is terminated and I did not enter into an agreement with my employer, that triggered a taxable event from my end. Then I have to report it as income. So be careful when you're borrowing against. If you're going to take money out, don't take money out. Find borrowing against 401k or IRA first, because you'll be hit with the penalties. I'll talk about that later. All right, gifts and inheritance. So for gifts and inheritance, when you receive a gift or you receive something as an inheritance, that amount is excluded from gross income. When you receive it, I should say, that transaction, when you receive it, that transaction itself is excluded from gross income. However, if you later turn around and sell it, you may have a taxable event there. So let's say I received something. I received something. I received stock, either as a gift or as an inheritance. When I receive that stock, that's not an income. But if I later sell the stock, that's a different event. That's considered income. Let's say I receive a house. This is pretty common. Say my parents gave me a condo. Again, not taxable to me, but it may be a taxable event to them, but not taxable to me in that event. Let's say I later turn around and sell the condo. That may be a taxable event. Again, the first transaction of receiving the actual gift, that's excluded from gross income. If you later turn around and sell it, that may be a taxable event depending on circumstances. Now, in terms of municipal bonds, again, the interest itself is excluded from gross income. Pretty straightforward. We talk about that. But what else can happen with that bond itself? Well, if you sell the bond at a gain or a loss, well, it's just like selling any type of property. That's going to be considered a gain or a loss. Bonds, stocks, those are capital assets. So just keep that in mind. So that may be a capital gain or capital, loss itself when you sell it. But when the interest portion of it, that's excluded. But when you sell the bond, that's income to you. Now, the compensation for injuries, that's something I do want to spend some time on because it is pretty common. So physical injury. You sue somebody and they sue you for physical injuries. Your recovery is for compensatory damages. If it's for compensatory damages such as lost wages, to recover your medical expenses, to cover the damaged property, that's excluded for physical injuries. If you're trying to recover or you've been awarded by the court punitive damages or actual damages, that's the punitive damage. I mean, the punitive damages are included as income. Again, compensatory damages, what they're compensating you for, the reimbursement portion of it, that's considered excluded. The punitive damages, that's income. What if you sue somebody because they hurt your feelings? I kind of say that as a joke. The first one, they hurt you physically. It's more than hurting your feelings. This one, they hurt your feelings. So you sue somebody for defamation of character. You sue somebody for slander. You sue somebody for discrimination. Whatever the case may be, it's a non-physical injury. Everything is considered income. Doesn't matter if it's punitive, compensatory damage. Doesn't matter. It's all considered income. Workers' compensation, that's excluded. So if something happens at your job and then you recover some type of workers' compensation, that's excluded. By the way, unemployment compensation, that's income. I did not include that in the list, but that's considered income. Now, again, to talk a little bit about accidental and disability plans, it really depends on who actually paid for the premiums. If the premiums are paid by the employee, it's excluded. If the premiums are paid by the employer, it's included as income, and you usually get a W-2. But again, if you're paying these premiums on your own, the premiums that you pay, you don't get a deduction for it. Not for disability plans or accidental plans. Medical and health insurance plans, you do, but not for accidental and disability plans. There is no deduction for that. No deduction, then when you recover from it, it's excluded from gross income. I would say these type of plans, there's a lot of recoveries in these type of plans nowadays with what's happening with the coronavirus. Damages, this is this particular section 139F, fairly new, somewhat new code section. This is unfortunate that a lot of individuals have been wrongfully convicted and do time in our prisons. Some people say that our prison system is not, well, it's not perfect. I'm one of them. It's not perfect. Because of that fact, a lot of individuals do a lot of time and they get exonerated in the future. So what else happens with that? Then not only do they get exonerated, that's great, but what else? Well, they lost a lot of time. Now they're gonna they're gonna sue, the government for damages. These damages are excluded from gross income so long as the taxpayer is exonerated from the crime. So as long as the taxpayer is exonerated from the crime, and that's usually what usually happens. By the way, it's usually a procedure. They get exonerated first, and then the city and state's attorneys, then they agree on a recovery. But usually the exoneration comes first. Don't know of any cases where there's no exoneration. Again, there was no exoneration, and the state and or local government still agreed to pay the taxpayer. I don't know of any case of that. Yeah. Yeah, I guess that, yeah, that's the case. If it's, if yeah, again, it would have to be not, yeah, the taxpayer will ultimately have to be found. Well, I guess I was gonna say not guilty, but just because somebody's exonerated doesn't mean that they're necessarily not guilty. Exoneration is just the legal way of you can still be exonerated. Yeah, yeah. In that case, you're right. You're right. That's yeah. Again, with the exoneration part, that's when they're not guilty of said crimes. I guess. Well, again, I want to say it's not always the same thing, but just the buzzword. There has to be some exoneration that took place. Some exoneration took place, and it is a long process. It does go through court and maybe even the federal court system. But again, I don't know of any fact where somebody had a recovery and there was no exoneration, because usually the exoneration comes first before the recovery. But for tax purposes, it's together. It kind of works. Well, you get the damages, but you have to be exonerated. Well, that's sort of how it works. You get exonerated, then you get the damages. Again, it is a common issue. Um, what about the attorney fees? Something to think about. Um, Attorney fees are not deductible anymore. Yes, I said that. General rule or medical reimbursement plans. This is actually governed under two sections. The book doesn't really spend too much time on it, but they have a lot of good, information on it. General rule excluded. Pretty straightforward. Um, all right. Cancellation of indebtedness. Section 108. Remember, I said any income that's forgiven, any debt that's forgiven is considered income from your end. That's true. Here's the exception: bankruptcy. So again, there's a lot of forgiven indebtedness in bankruptcies. Taxpayer filed for bankruptcy, it's not considered income. Taxpayer is insolvent, meaning the liabilities after the cancellation of indebtedness, the liability is more than the fair value of assets. Again, they're insolvent. They're broke. In a lot of cases, if they're insolvent, they file for bankruptcy, but that's not always the case. Again, if they're insolvent, that's also an option. Student loans, to some extent, that's an option. So the student loans, just to give you a couple of scenarios regarding student loans, this is pretty common in teachers that find a job at a at-risk school and they get their student loans canceled, at least a portion of it. I've seen that type of situation. Doctors decide to work for after they finish medical school, decide to work for a low-income clinic. Attorneys, the same thing. Attorneys work for innocent project type of clinics. Again, in exchange for a portion of their student loans getting canceled. So that's considered excluded from gross income. A lot of arrangements like that are still, pretty common. When there's shareholders, corporation owes money to the shareholders. The shareholder can actually cancel the debt. Sort of. It's sort of convertible, instrument. What happened in this situation? The shareholder will cancel the corporation's indebtedness in exchange, for stock. That's usually how it works. Now, I put too many ones here. uh, no, I don't think it's been extended. Mortgage discharge from personal residence. So this is how this worked. This actually started in 2007, and I talk about 2007 a lot. 2008, the real estate market crash. So a lot of properties were being foreclosed. Before that, your property got foreclosed. That's considered income to you. Any canceled indebtedness is considered income to you. That was the old law. Okay, again, this dates back to 2007. So for 2007 up until like 2010, they actually provided this relief. As long as it's part of your personal residence, it's excluded. As long as it's part of your personal residence, it's excluded. Again, 2010, they extended it a couple years, extended it a couple years, extended it a couple years. And then something that happened in 2017 did not get extended. So depending on how you read it, if in 2018, if you had canceled indebtedness in 2018, it's in that case, again, it wasn't, or again, it ended in 2017 back then. So if you had canceled indebtedness in 2018, it's considered income. Again, I'm kind of giving you a history of the tax law, because the Tax Cuts and Jobs Act didn't address this. So 2018 is considered income. A later tax bill that was passed in actually, it was this tax bill in 2019, I think, that or maybe it's the one that just passed this year. Either there was a bill that was passed either at the end of last year, 2019, or early this year. I don't remember which. That retroactively, actually no, this was a bill that was passed at the beginning of tax season. This bill retroactively made the adjustment for a mortgage discharge of indebtedness for a couple more years, and that was actually 2020. So they extended it for 2020. Remember what I just said in 2018? If your cancel, if your loan was canceled, even on your principal residence, it's considered income. So you file your 2018 tax return under the tax law as it was given at that point. You reported it as income. But later on, after filing tax season, until the next year, they retroactively changed the law. Now you can amend your tax return for 2018 because it wasn't supposed to be income. You see what can happen? I'm explaining to you just so you can see what can happen in actual real life, tax practice. 2018, we went by tax law. We followed the tax law. It's income. Then in 2020, that was a bill that was passed this year. They changed it and said, well, wait a minute, let's change back the tax laws for 2018. So now we got to tell our taxpayers that were affected by this. Guess what? We got to amend the return because of this. So now they kicked the bucket for 2 more years, and I'm pretty sure it didn't get extended to 2021. Yeah, I'm pretty sure it didn't. I'll double check the year, but I'm pretty sure it didn't get extended to 2021. At the very least, they got until the end of December 31st, 2020. I'll double check on that date in 2020. But again, so any mortgage forgiveness as it is right now from 27 to 2021 or whatever the old date is on your personal residence, it's excluded as it is right now. Again, don't quote me on it being 20 or 21. I'll check in a little bit. All right, the recovery of tax benefit rule. Oh, and by the way, you got to fill out a form once you exclude it. It's Form 982. It tells you how to exclude it. You don't just apply it. You got to make sure you file the right forms correctly, and it tells you specific instructions how to do this. There's a couple other exclusions that there's one that I'm missing. This relates to property. You make an adjustment to your basis on certain property and real estate. Again, that's the other option I'm leaving out for right now. Tax benefit As I mentioned before, the recovery of tax benefit is income to the extent of tax benefit. In other words, you claim a deduction 1 year and recover, and the recovery is in a refund year. The future year is considered income to the extent that you benefited from it in the previous year. Again, similar to the concept that I just explained on the traditional IRAs, deduction 1 year and then you get it the future year is considered income in the future year. Now, the next couple of sections that I want to talk about, rental income. We're going to talk about rental income a lot, and that has several sections of the Internal Revenue Code. 61 for sure, Section 280 capital A, which talks a lot about rental income, but it also talks a lot about vacation homes. Section 280 capital A also talks about home offices. But what we're going to talk about today, we're going to talk about the vacation home side of it and the rental income side of it. 469, that's the passive activity losses, but the one that I'm referring to is rental losses. So here's how it works. Rental income. Rental income is included in gross income except when it's not. That was a joke. Rental income is income except when it's not. Well, this is when it's considered not income. It depends on how long they rented it for the year. If the property was rented out for less than 15 days, that's 14 days or less, it's excluded from gross income. So again, if it's rented for less than 15 days, no gross income. So what happens with the business deduction? Well, there's no business deduction. In this case, it's treated as a second personal residence. You know, it's not a vacation home. It's treated as a second personal residence. I guess if you think about it, it may be a vacation home. The way you look at it, they go there every now and then, but it's not a vacation home under the eyes of tax law. Again, that's what I want you to understand. When we talk about resident alien, we talk about vacation home, whatever it may be, it may not be the way you actually look at it. A vacation home in this case is a vacation home as it is applicable according to tax law. But the way it looks here, again, you rented it for less than 15 days. It's personal, even though it's your vacation home, the way you worded it, but not vacation home for tax law. No income. No business deduction. So what happens to those items that you incur? Think about this for a second. On your personal residence, what are the only items that you can deduct on your personal residence? I'm asking. What are the only items you can deduct for your personal residence that you may be able to deduct? What do you guys think? I gave you this itemized deduction list before. There's only like 2 items that should stick out related to your personal residence. What can you deduct? There's only 2 things that stick out. On your personal residence, anybody? Mortgage interest. What's the other one?
Property taxes?
Property taxes. That's it. Again, I'm going to say this again. On your personal residence, what's the only thing you can deduct? Mortgage interest and property taxes. Can you deduct utilities? No. Can you deduct insurance? No. Can you deduct the depreciation? Well, you don't have depreciation because it's your personal residence. You can't depreciate it. So the only thing you can deduct is mortgage interest and property taxes. So this is how it works. Because you rented it for less than 15 days, it's your personal residence. What can you deduct here? Just your interest and property taxes as an itemized deduction. You're deducting them as an itemized deduction. So keep that in mind. Again, if it's rented for less than 15 days, it's treated as personal. It's like any other personal expenses. The only thing you can deduct for personal residence is on itemized deduction, interest, and property taxes. What about the second scenario? So what happens if you rent it for more than 14 days, 15 days or more? It is considered income to you. You got to report the income no matter what. But in this case, what do you have? You either have a vacation home under Section 280 capital A, have a rental property under Section 469. You can't have both. You can never have a rental property and a vacation home. It's either vacation home or rental property. Tax law and the facts and circumstances would dictate that. We'll go over that in more detail a little bit later. More on stuff that's related to rental types arrangements, lease improvements, leasehold improvements, lessee improvements. So the lessee is making improvements on the apartment or the office, whatever it may be. If the agreement is in exchange for rent, so let's say in my apartment, I'm going to pay, and instead of paying my landlord, I want to fix up the bathroom, remodel the bathroom. And I told them I want to remodel the bathroom, but it's going to be money out of my pocket. I want this to be in exchange for rent for the first month, second month, whatever type of arrangement. To the lessor, that's considered income to him. Again, if it's exchanged for rent, that's a bartering transaction, right? That's considered income to him. What if it's not exchanged for rent? Let's say I'm going to do the remodeling of my apartment on my own. I did get approved by my landlord, but it's not going to be reduced. They're not going to reduce my rent. It's just I just wanted a new bathroom. That in that case, the lessor is not considered reporting it as income. Pretty straightforward, right? Scholarships. Scholarships are pretty straightforward. Scholarships, so long as they pay tuition and related fees, that's excluded. Anything that's in cover room and board, that's considered income. Now, I'm going to put this in a couple of different places, the no double benefit rule. Again, if you're excluding it from gross income in one respect, you can later on claim a tax benefit or deduction for the same item. That's anything. So if I'm already excluding it from a scholarship because I'm paying my tuition, I can't later on take a tax credit for it. Think about it. I can't take a tax benefit on tax-free money. That's the way it works. I can't get a tax credit on tax-free money. That's a double tax benefit. I'm already benefiting from excluding it from gross income. I can't benefit from it again, claiming a related tax credit for it. That's a double benefit. It won't work. And that's everywhere in the Internal Revenue Code. Next section. I sort of put it by sequential order to some degree. 117, the next section. I did skip a couple of sections, by the way. Next section is section 119. That's the meals and lodging. Now, for meals and lodging, it all depends on what the employer is actually covering. If the employer is covering meals, the two conditions that must be met for meals are just it's at the employer's premise and at the convenience of the employer. So let's say you work at McDonald's. McDonald's wants you to take a 30-minute break, and they'll pay for your meal, your lunch. Does it meet the criteria here? It's at the employer's premise, yes, and it's for the convenience for the employer, yes, right? So then in that case, the meals would be excluded from gross income. What about lodging? Lodging is a separate requirement. The first two requirements have to be met. The third requirement is paramount. Is it a requirement for your employer that has to be met in addition for it being the convenience of the employer and at the employer's premise? A common example would be, let's say university professors, they do enter in similar arrangements where, again, the employer premise, on campus, is at the convenience of the employer, so they want the university professor to be on call, and then there's the requirement for employment, so that it would work. So again, the university professor is actually a pretty common one. Ministers will also work and other individuals. So other housing issues in terms of what's included and what can be excluded. Not everything is excluded. There is some abuse here, by the way, but not everything is excluded. This is what can be excluded. So again, here's where I would talk about the university professors, educators, not just educators, but employees in general. The amount that's excluded if the annual rents that are paid is equal to or greater than 5% of the value of the facility. That's the excluded portion of it. For ministers and other religious leaders, again, what you're excluding is the fair value of your housing, the rental allowance. You can't say that 100% of the compensation of a minister is all housing. That's abuse. You can say most of it can possibly be, a good portion of it can possibly be, but not all of it. Not all of it. The same thing for, professors. You can't say an educator, 100% of their salary is used for, for housing. Military personnel, same thing, but it's generally excluded from personnel. Now, in terms of tax deduction, tax deductions change on meals and entertainment. Under Tax Cuts and Jobs Act, meals and entertainment for everything is 50% now. Under old tax law, for these type of meals, the employee meals, it was 100% deductible, so long as it meets the employer premise and convenience of the employer test. That was under old tax law. Under new tax law, it's 50% deductible. Entertainment is no longer deductible, in case you're wondering. All right, continuing with our deduction of fringe benefits. Cafeteria plan, some of you may be familiar with this. These are Section 125 plan. Sort of works like a cafeteria in a way. So this is a plan where the employer can choose between cash and non-taxable, I forgot how to spell benefit, and non-taxable benefits. It could exclude group insurance, health insurance, childcare, and so forth. So they have like a cafeteria, a menu, so to speak, of different types of benefits. The employee tuition reimbursement, your employer covers your tuition. The most that can be excluded is up to $5,250. Any excess amount will be considered compensation. Same thing here, no double tax benefit. You're already excluding $5,250 from gross income. You can later on and take a tax credit for the same amount of tax-free funds under the tax benefit rule, double tax benefit rule. And dependent care assistance, Section 129, they exclude a portion of dependent care assistance up to $5,000 per year or 25. Yeah, I said this backwards. I got this backwards. $2,500 per year. I have this backwards, and $5,000. Married filing jointly. What was I doing when I typed this? Again, this is backwards. Either way, that's the excluded amount, the $5,000 excluded amount. This works. This is tied into the dependent care credit. You can't. It works together. You got to ask the information. They still may get a dependent care credit for the amount that they didn't get reimbursed. So just keep that in mind. Adoption assistant, that's been in the books for years. Your employer can assist you up to, and you can exclude up to 14,300 of adoption assistance. But there is a phase out. The phase out amount is pretty lenient, I think. Here's where it starts phasing out. So once you reach the top upper threshold, you don't exclude any of it. It's all considered income. That's how that works. Employee spending accounts, flexible spending accounts. Some of you may be familiar with this. This is for money that you put aside and again, your medical reimbursement type accounts, and your employer is paying for your specific medical procedure. The most that you can exclude is $2,750 for year 2020. Again, these are still pretty common. Similar to this, you probably may see HSA or MSA plans. They work very similar to these type of plans, but the amount that you can contribute is actually more than the $2,750 for those type of plans. Other types of plans that or types of benefits that your employer can provide. Let's say your employer is providing services for free. They're doing your tax return for free. Then in this case, the amount should be excluded if you meet the following conditions. Again, you're receiving services. So in that case, I'm doing your tax return for free. You're my employee. Yes, you're receiving services. I'm not incurring any additional costs. So the cost that I'm incurring is going to be the same no matter what. These services are available to customers. So I'm doing tax services to anybody else. So again, anytime you get some kind of benefit, some kind of something for free from your employer, it's generally excluded so long as these three criteria are met. For discounts, same thing. The only thing about discounts, so long as the discount does not exceed the employer's gross income or gross profit, that should be gross profit percent. Gross profit percent, that should be fine. And usually they give you a 10%, 5%. It's usually way below the gross profit percent. Any working condition fringe benefits. Let's say your company pays for your CPA license, or they pay for your continuing education. That's the working condition benefits. Those are tax-free. Now, the moving expense reimbursement. This has changed as part of the Tax Cuts and Jobs Act. Under old tax law, if your job paid for you to relocate to a new job, you were able to exclude a certain portion of it. Now, the threshold changes, but it was up to like $5,000 and change before. Now, as part of the Tax Cuts and Jobs Act, the only individuals that can benefit from this is individuals in the military. So that changed a lot. Group term life insurance. If you have group term life insurance and your employer, you get to exclude up to $50,000 of premium paid. And this is usually on your W-2. If it's more than $50,000, then the excess gets attached to your W-2. How many people like these type of plans, the employee expense reimbursement plans? Well, there's two types of plans. There's the accountable plans and the non-accountable plans. The accountable plan, this is where your employer requires you to submit an expense report. You got to provide substantiation. You got to provide proof, your receipts. In this accountable plan, not only that, the accountable plan itself tells you you're going to get reimbursed X amount per meal. You're going to get reimbursed X amount for continuing education. They tell you specific amounts and specific expenses, line items, on what gets reimbursed. That's excluded from gross income. Again, an accountable plan, that's excluded from gross income. Non-accountable plan, on the other hand, it works a bit different. You're not required to submit an expense report. Your employer does not require you to provide any substantiation. Instead, your employer usually gives you an allowance amount. As long you can use this money as anywhere you see fit. That allowance amount is included in gross income. One thing I want you to keep in mind regarding these two types of plans. The second type of plan, if you think about it, because it's already included in gross income, then what if you have employee expense reports or employee business expenses? Let's say you have you're paying for your CPA license, you're paying for your continuing education. Under old tax law, those would be employee business expense deductions. You'll be allowed to take a deduction. Under new tax law, under Tax Cuts and Jobs Act, that whole line item has been eliminated. It's sort of pushing more, it should, at least in theory, pushing more companies to do accountable plans than non-accountable plans, because that would benefit both parties involved, not just the employer. The employee would benefit from this as well, since they'll be able to exclude it from gross income. Transportation, there are some fringe benefits on transportation. These numbers are indexed. Again, if there's $270 of coverage and if you take the highway, the most you can exclude is $270 per month. CTA passes or any similar transit passes up to $270 per month. Parking, $270 per month. There used to be a bicycle exclusion that got eliminated. I don't know why, but it got eliminated. Foreign income exclusion. If you work in a different country, you get to exclude up to, and this amount is indexed, 107,600, so long as you meet these two conditions. You're a bona fide resident of the foreign country, and you reside in the foreign country for 330 days during 12 consecutive months. Now, the 330 days does not have to be met all in the same time window. It can be met, as long as it's met within 12 months, it can be met in 2 different years. Let's assume that it was met, 50-50, 50% in one year, 50% in the other year. And in that case, you'll just split the excluded amount. So you'll be able to exclude, like 53,000 and change each year, half of it each year. That's the amount that you'll be able to include each year. You'll just prorate it. Again, pretty straightforward. That's a common, form that's used. 2555 is the form that's used for that to fill out the foreign income exclusion. Qualified tuition plans, state prepaid plans, Section 529 plans. So long as the proceeds are used to pay qualified higher education, including, and this one actually does include room and board. That's excluded from gross income. Same thing, no double benefit rule. You're excluded from gross income. You can't later take a tax deduction in the future. The next section that I have, this relates to corporate distributions. This is covered in more detail in my corporate and entity tax class. But I do want you to at least think about this, because this is sort of how corporate distributions are taxed. There's something that's known as earnings and profits. That's what retained earnings sort of is. But for right now, I want you to think of retained earnings as earnings and profits. Not the same thing, but for right now, let's say it's the same thing. What's retained earnings? Undistributed earnings, right? So this is earnings that have not been distributed to the owners. So on that concept, it is the same thing as earnings and profits. So earnings and profits, if the corporation has earnings and profits, then it's a taxable dividend to the shareholder. Again, this is where that double taxation comes in. So there's earnings, then it's double tax, then it is double tax. Earnings and profits, it gets becomes a taxable dividend to the shareholder. What if the shareholder does not have earning, or the corporation does not have earnings and profits? Then it becomes a tax-free capital gain, or not capital gain distribution. It's a return of capital to the extent of the shareholder's basis. And then the third scenario, shareholder has no basis and corporation has no earnings and profits. Then it becomes a capital gain distribution. Let's just, draw it up. Corporate net income is 20,000. All right, let's just say 10,000. So shareholder basis is 3,000. So year one distribution is 8,000. So what is the outcome here? So does the corporation has earnings and profits? So this is E&P. E&P. Corporation does have earnings and profits. So in this case, outcome, because corp has E&P, the $8,000 is taxable to the shareholder, right? Everybody okay with that? Pretty straightforward, right? Shareholder or the corporation does have earnings and profits. That's the earnings, then that's taxable to the shareholder, right? No questions? All right, let's change the facts a little. Year two. By the way, what happens to retained earnings when you make a dividend? What happens to retained earnings when you make a dividend? Anybody? When you take out a dividend, what happens to retained earnings? It's a reduction, right? So think about this. So it works similar in this case. So if the $8,000 is a dividend to the shareholder based on my previous example, let's assume that the corporation did not have any earnings, so no current earnings. So no current earnings. So earnings and profits would be the same as last year's ending balance, right? So earnings and profits would be what in this case? $2,000, right? You guys see how we got to $2,000? $10,000 minus, again, just basic retained earnings. $10,000 minus $18,000 from the previous scenario, it's $2,000. Everybody okay with that, right? I'm going to say the same fact pattern. They distribute $8,000 year two. What happens here in this case? What is the earnings profits? So because E and P is only 2,000, so 2,000 is taxable dividend, right? To shareholder, right? So what happens now? So again, this is the ordering rule. So now earnings and profit is 0, right? Earnings and profit is 0, right? Now we're at step 2. What happens now? Tax-free return of capital. Then the shareholder recovers his or her basis tax-free. So in this case, what was the basis? $3,000, right? But that's only $5,000 now. The excess of $3,000 is a capital gain distribution. Okay, you guys see how that works? Again, the first scenario, again, it's earnings and profit, so it's a taxable dividend, right? everything is taxable. Second scenario, there was no earnings. Simple. Earnings and profit is 2,000. Again, it works very similar to retained earnings. 10,000 minus the $8,000 of dividends, right? So now it's 2,000. Shareholders basis is 3,000. The distribution is still, they made a distribution of 8,000, right? So how is that $8,000? How is that considered? It's $2,000 taxable dividend because that's the earnings and profits, right? Then the shareholder recovers his basis up to $3,000 tax-free, right? And then whatever's excess, $3,000 is a capital gain distribution. 2,000, 3,000, 3,000, that equals the $8,000 distribution, right? Suppose that the distribution was only, in this case, $4,000. Again, suppose that the distribution in year 2 was only $4,000. So what would happen in that case? If it was only $4,000, $2,000 would be a capital, or would be the dividend, right? That's still a dividend, and only $2,000 capital or tax-free return of capital. That's it. His basis would be $1,000 now. Pretty straightforward, right? Again, we'll get into more detail with these type of issues in more detail in corporate and entity class, but I want you to at least get an idea how dividends are taxed. It's not as straightforward as you may think. There is an ordering rule. It's earnings and profits driven. Stock dividends. Stock dividends generally excluded from gross income, except when the taxpayer has an option to receive the stock dividend, the cash. Even if they don't receive the dividend, even if they don't receive the cash, it's still considered income. So the only time is when they have an option to receive cash, that's when it's considered income. Any questions on this chapter? No questions at all? All right, wait. Good. That means you guys are getting it. I want to start talking about tax deductions, and then at least briefly. At least again, at least the chapter 6 questions. All right, the next section that I want to cover. So this is what we're going to do today. Again, I did want to introduce this so you guys can have an idea how it works. So we're going to talk about tax deduction and losses, deductions for AGI and deductions from AGI. We'll talk about hobby activities. We're going to start talking about vacation homes. We may not get into this problem today, but I do want you to at least understand how it works. We're going to talk about the entity table. There's a table that I have on Brightspace. I don't think we're going to get a chance to get into the problems today. By the way, there are some coronavirus updates. Actually, there's more updates than again, this is from last semester, so I haven't updated all the articles. Nonetheless, you can click on these articles. It provides you a lot of useful information. But there has been more guidance than just these on the coronavirus. But these are tax updates. They're the AICPA website. The Illinois CPA Society also has a similar link. All right, so in terms of business deductions, now the next section that I want to talk about, this is split into different categories. What I want you to think about, and this is where I use my mnemonic, be hip. Taxpayers can be hip when determining if something is tax deductible. And let me share this screen. And by the way, I had to buy a vowel. All right, so this handout is on Brightspace. I haven't updated this. Yeah, now that I think about it, I should update this because Tax Cuts and Jobs Act pretty much changed all this. Nonetheless, the concepts, the underlying concepts where I have entrepreneurial effort and profit motive, these are still the same. These still apply. But in terms of deductions, for the most part, yeah, these have changed actually. But let's talk about each one. Letter B, business at trade deduction. That's governed under Section 162. Just think of it logically. There has to be entrepreneurial effort. You're running it like a business. You're dedicating your time and effort. You're reading journals. You have an actual ledger, an accounting software. You're running it like a business. And even if you don't make a profit, you do have to have a profit motive. So there has to be revenues, right? Some type of cash flow or projected revenues. Deductions, for the most part, it's unlimited. Many and all for the most part. There are some limitations here, as I mentioned. Hobby, on the other hand, that's where the H comes in. That's section 183. For a hobby, it's very similar in terms of entrepreneurial effort. There could be entrepreneurial effort, meaning you do dedicate yourself, a lot. You read journals. You may even have a ledger. Let's say I'll give you an example. For me, um, I like to run a lot. I like to participate in different races. So I have a training plan that I follow. I read the Runner's World magazine. I have all these journals, and very anal retentive when it comes to I run it like a business, so to speak. So the entrepreneurial effort is there. Do I run to make a profit? No. Occasionally, I may win a prize or something to that effect, but it's not my motive to actually make a profit. So the profit motive is lacking. I'm going to talk about that in more detail. The profit motive is lacking. I don't have to have revenues. Hobby expenses are limited to gross income. That's still there, by the way. The hobby expenses are limited to hobby income. And I'll tell you why it's not deductible anymore. Now, the I, it's not necessarily an I, but I had to borrow a vowel in order for my BHIP mnemonic to work. The I is actually I for investment, but not just investment. Section 212, that's production of income deduction. But it is investment driven in a way, but there has to be income. So the profit motive has to be met, right? Entrepreneurial effort does not have to be met. So think of it like sort of like an investment. I'm not in it actively participating to make money. I'm just there sitting around to earn a profit. Entrepreneurial effort is not present. Profit motive is present. Now, in this case, it's limited. It's limited to gross income from that activity. Now, for personal expenses, personal expenses, that's governed by 262. That's why a lot of personal losses are disallowed. No entrepreneurial effort, no profit motive, very, very few. Very few. Again, this is something I want you to take a look at. Now, one thing I want you to think about regarding hobby expenses and production of income deductions, these two, they used to be itemized deduction, miscellaneous deduction subject to the 2% adjusted gross income floor. Those 2% AGI floor expenses are no longer there. So hobby expenses and production of income deductions are not deductible. Remember earlier when I said attorney fees are no longer deductible? That's because it's not deductible anymore. Miscellaneous expenses are not deductible anymore. Now, it all depends on the circumstances. But if it used to be under miscellaneous expenses, that's not deductible anymore. Now let's go back to the slides. Go ahead. Floor. Right. Right. What's the question? No, that's not how it, no. It's over the floor. You're, exactly. That's the minimum. Now the 2% is the 2% floor is not there, but there's other floors, by the way. We have other floors on medical expenses. 7.5% floor. Let's say the 7.5% is $750. Again, I'm not going to work backwards to figure out what your AGI is. So $750 is your 7.5% floor. You have $1,000 of medical expenses. How much can you deduct? Not $1,000. $250. Again, $1,000 medical expenses, right? Your floor is $750. You have to be over the floor, right? How much are you over the floor? 750. I mean, 750 is your floor. 250 is your excess over the floor, right? Okay, the medical expenses, let's change the facts a little. 750 is still your floor. Medical expenses is $500. How much can you deduct? Nothing. You have to be over the floor. That's how that works. Now, the 2% floor used to be in there, but same principle. It's no longer, not that the floor is no longer there, just that whole line item is not deductible anymore at all. Not that the floor is no longer there, it's not deductible. So anytime I'm talking about the 2% AGI floor, that whole section of the Schedule A got eliminated. It's not deductible anymore, temporarily. The floor is still there. I guess the way to look at it, the floor is still there. It's just not deductible. Hobby expenses are still there. It's just not deductible. Production of income deductions are still there, but it's just not deductible. You know, that's how that works. So if you think about it, can you claim home office expenses for employees? Yeah, but there's no deduction there. Remember, the 2% AGI floor has been eliminated. So just keep that in mind. You know, something going forward. All right, partial list of AGI deductions. This is just a partial list. These are deductions for AGI. Again, partial list. You know, I want you just to think of an idea of, you know, what's deductible. Business and trade expenses, and again, non-employee expenses. Again, non-employee business expenses, by the way. And this also includes rental homes, vacation homes. Those are business expenses, by the way. Above the line deductions. If you sell investment property, i.e. Your capital assets, losses are deducted, limited to $3,000. Losses from the sale of fixed assets, which are not capital assets, you may be able to deduct all of it. Rental losses, assuming that you meet the criteria, you may be able to deduct it. Alimony paid, as long as the alimony was finalized in 2018 or prior years, you'll be able to take that as a deduction. The recipient claims it as income. Half of the self-employment tax, we're going to start covering next in a couple weeks. Half of the self-employment tax, that's deductible. You cannot net the two. Let's say your self-employment tax is $1,500. You're still paying $1,500 plus the income tax. $1,500 is still your self-employment tax. $750 would be a deduction for AGI. $1,500 is still your self-employment tax. Along the line with self-employed individual taxpayer deductions, if you have health insurance premiums and you're paying and you're self-employed, that's a deduction for AGI, limited to your net income from self-employment activities. Contributions to traditional IRAs, that's a deduction for AGI. Contributions to self-employed retirement accounts, SEP plans, KEO plans, we'll talk about that in more detail. That's limited to 20% of your net income. And again, that's a very good deduction. You'll be able to claim more for self-employed individuals. Early withdrawal penalty on time deposits. Some of you may know how this works. If you have a CD, that's a time deposit. Savings accounts, some, but not all, have a time limit. CD meaning you have to keep the CD 2 years, 3 years, 4 years, whatever the case may be. You get the money out when it matures, right? But let's say you need the money it's an urgent need and you need to withdraw the CD. You had to cash it out. It was a 2-year CD. You had to cash it out within 1 year. You may notice that when you have that CD, there's a provision in there that you forfeit a portion of your interest as a penalty if you take out your money early. Not to be confused when you're taking out money from a retirement account. This is when you're taking money out early from a CD. They're going to take out a certain percentage. That amount that they're taking out, the forfeited interest, that's a deduction for AGI. Again, do not confuse this with the penalty on early withdrawal for 401ks and IRAs. This is early withdrawal on time deposit. You do get a deduction for that. Moving expense deduction. This used to be deductible for everybody as long as you meet the time and distance test. If you get relocated for work, then you'll be able to take that deduction. It's limited now only to military personnel, from 2018 to 2025. Student loan interest is still deducted. Tuition and fee deduction. Actually, funny thing about tuition and fee deduction. Remember what I just said about about a couple provisions that that did not exist or expired in 2017, that did not exist in 2018, but in 2020 Congress retroactively adjusted them. Tuition and fee deduction is one of them. Again, this is how Congress works for you sometimes. Again, I'm going to go on a bit of a tangent a little bit because I have to complain about Congress every now and then. So again, in 2018, again, they passed a 2018 bill in 2017. Again, the Tax Cuts and Jobs Act, right? So again, a 2018 bill in 2017. But then they passed a 2018 bill in 2017 bill was passed in 2018, right? Which didn't make sense. And then they passed a 2017 bill in 2018. Yes, Congress did that in 2018. Again, they're a bit backwards. Same thing happened even this year. Remember in 2020, they passed a bill for 2018, which didn't make any sense. Again, this is the way Congress works. Don't be surprised if you see something like that happen. You know, you just, I guess the way I look at it, you just have an opportunity to make more money from clients. Tax laws do change very frequently, and it is common for Congress to change stuff like that retroactively. It just happened the last couple years. It just happened so frequently. You know, I could have never imagined for it to happen. You know, subsequent years, consecutive years, I should say. It's just odd. Okay, I'm off the tangent now. Now to business deduction. Business deductions, pretty straightforward. It must be ordinary and necessary. That's it. It must be ordinary and necessary in your line of business. So that means I could deduct, accountant fees. It's ordinary and necessary to hire an accountant. Ordinary and necessary to hire an attorney to give you business advice or legal advice. Is it ordinary and necessary to hire a tarot card reader or palm reader to give you advice? Let's say it's common for other CPAs to do it, but is it necessary? No. Those type of deductions are not deductible. Again, use your logic with that. It has to be ordinary and necessary. What's not allowed as a business deduction? Actually, I think somebody asked me this question last week when it relates to S corporations. I think the question was, can S corporations take a deduction for charity? What was my answer back then? Short and simple. Anybody remember last week?
It's a pass-through entity, so no, I guess, unless like you do it in your personal income tax.
Well, I said it was not a business deduction. It does flow through. It does flow through, but it's not a business deduction. It still gets reported on K1. It still gets reported on the tax return, but it doesn't get a deduction. Well, the reason why I asked that question again, is that a business deduction? Is charity a business deduction? That's the takeaway that I wanted you to get from my explanation last week. Charity is not a business deduction. The charity is still reported on K1. It flows through. And you're right, it does get reported on the K1 or it gets reported as an itemized deduction on the personal individual tax return. But not that it's not deductible. It flows through. Think of it this way, for other items flows through as well. Think of it this way. I'm in the business of selling widgets, whatever widgets are. So any expenses related to selling widgets, cost of goods sold, operating expenses, are ordinary and necessary expenses, right? Is charity an ordinary and necessary business expense? No. Is that an operating expense? No. So it's not an operating expense by definition under tax law, so it's not considered ordinary and necessary. So it's not considered a business deduction, so there's no deduction for it. Should you make charity? Yeah, you should always be charitable, but that would just flow through. It would be a separately stated item. So again, it's not that it's not deductible, it's a separately stated item. Again, it's not computed as part of their business income. I guess it would be a better way of explaining it. So there's no business deduction. But not that you're just going to split it apart and just report it separately it still gets reported on the K1. It still gets reported on the tax return, but it flows through. But if you look at the line item, it's not going to reduce the net income of the tax return. It's going to flow through. But what else is not deductible? Bribes, not deductible. That's never been deductible. Fines, penalties, never been deductible. Lobbying and political contributions, not deductible. 50% of meals, not deductible. 50% is deductible. 100% of entertainment, not deductible. Now with this one, pretty common. I can take out my clients for lunch, dinner. That's 50% deductible. But can I take out my clients to a football game? No. Well, I could, but can I take the cost of the ticket as a deduction? No. The ticket itself, that's entertainment. That's not deductible. I can make well. See that's what I was gonna say. Now I can make an argument. The meals. Now, as far as the beers, that's it's a bit in the gray area. If I would say, yeah, then in that case, yeah, meals, 50% of the meals and entertainment would be deductible. So yeah, I guess I can drink beer and eat hot dogs and hamburgers there and deduct 50% of it. Now, in theory, and this is just in theory at least, if you're taking out a client just for drinks, technically speaking, you cannot take out that as a deduction because that's entertainment. Now, if you take them out at a bar and there's appetizers there, well, there's meals there. It sounds kind of funny, but that's sort of what they were trying to, take away. You can't really entertain your clients, but you can dine them, so to speak, which doesn't necessarily make sense. But what's one industry that's adversely affected by this? A lot of deals are made in golfing, right? Right? That's entertainment. Pretty much a good portion of it is entertainment, and very little goes to the meals. So they're going to have to change the structure and how that's allocated. Because right now, whatever gets at, pretty much, you go golfing, it's not deductible. Just something to think about. Any question on ordinary and necessary expenses? Pretty straightforward. Okay, so you're asking me multiple questions there. Question, but it's not. It's not. It's not. Actually have a video on this on my. You haven't gone to my YouTube page, have you? What have I? Oh well, that's like the first video that you see right there. I have a couple cannabis videos. That's actually a very good question, and this is pretty common. As a practitioner, I can deduct my office expense. As a practitioner, I can deduct everything. I'm an ordinary, practitioner. For me, there's no limitations. For the cannabis dispensary itself, there are limitations. For the cannabis cultivator and growers, there are limitations. The only thing that can be deducted for cannabis industry is cost of goods sold. So this is how it works for the cannabis industry, and it's specific to the code section. Doesn't matter if it's legal under state statute, federal statute trumps that. So under federal statute, this is how it works. Section 280 capital E of the Internal Revenue Code. Again, Section 280 capital E states that any individuals that are trafficking controlled Schedule 1 and Schedule 2 controlled substances cannot take a deduction. Period. So in that respect, there's no deduction at all. But where's the argument that they can deduct cost of goods sold? Now, the deduction for cost of goods sold is not because it's just exclusive for cannabis industry. Anybody can deduct cost of goods sold. And this is the regulation that it's very old regulation. Regulation 1.5, Regulation 1.61-3, again, Treasury Regulation 1.61-3, it states that any taxpayer that has merchandise available for sale or manufacturing, anybody who has inventory, period, can deduct the cost of the inventory at arriving at gross income. Translation, gross profit equals gross income. So this is what it means. How do we get to gross profit? Sales minus cost of goods sold equals gross profit. So what, again, 61 defines gross income. So what Treasury Regulation 1.61-3, all that's saying is your gross income is your gross profit. Anybody who sells inventory, your gross income is your gross profit. Hence, so the anybody in the cannabis industry can deduct cost of goods sold. So I guess that includes, yeah, everything that's, part of cost of goods sold, is included as a deduction. So how is it different? So what's included in cost of goods sold? So for a cannabis industry, again, it doesn't matter if it's legal in Illinois or wherever. The only thing they can deduct is the cost of inventory. So the cost of the weed would be deductible. The packaging material would be deductible. A certain material that prepares the asset for its intended purpose. And think about it, cost of inventory would be deductible. Packaging, labor associated with packaging, deductible. But what about the cashier? Is that deductible? No. What about the security? Is that deductible? No. Now, can you make an argument that some of it should be deductible? Well, the only part that would be deductible, the part that's associated with the production process, then it'll be deductible. Now, you guys, wait, I'm not done yet. You guys all took cost accounting class, right? In cost accounting class, this is where I want you to start thinking about why cultivators and craft growers they can deduct more because of the way it's set up. What goes into cost of goods sold for a manufacturing company? Pretty much everything, right? Direct materials, direct labor, overhead costs. So for a cultivator, pretty much all of it is cost of goods sold. So there's more opportunity for a cultivator or craft grower to deduct cost of goods sold because that's pretty much all the production process. Where dispensary, the production process is limited to just buying the weed, and a lot of it is already packaged anyway. You're just limited to just storage and some handling, and very limited to that, and just packaging, any labeling material. That's it. When it's a dispensary, but in some situations there may be like if there's joint products. I didn't mean to say that. I was thinking of cost accounting. When there's a joint product, you produce a particular product and then it splits. That's what I was thinking of. And I wasn't even thinking of that. But you guys get it, right? So there's certain relationships when it comes to a certain with the cannabis itself. It gets in, it gets processed even further, and then in that respect, some of that cost of goods sold would be part of cost of goods sold. So let's say they have like mixed use. Part of it they're selling the weed itself, and then some of it gets processed further to make cannabis infused products. Then again, part of the production process, so long as it's associated with the production process, it's deductible. That's pretty much it in a nutshell. Go ahead with your questions.
Um, well, first of all, actually, I haven't taken cost accounting yet, but I'm familiar with the concepts from my previous 181 and
Okay.
182. But I guess my next question would be about selling things. If you have this, I don't know what the laws are, so this may be disallowed. If you have legally purchasable things, so like I'm thinking about paraphernalia uh, at the dispensary,
Same thing.
you
Same
can't
thing.
deduct anything at all because you are trafficking with
Yeah,
the
same
goods.
thing. Yeah, and the funny thing is, there's a lot of case law. There's a couple of cases that along the same line. That was their argument. There was there was an argument that yeah, there was non-cannabis, and they were like, no, it's one business activity. It's be careful with that now. Now, I guess with something like that, ideally it would be in a perfect world, where they're selling the papers, the pipes, or what have you. Uh, it In order for that to work, they would have to have two separate locations. One would be like the smoke shop, so to speak. That's where they just sell products. They don't sell any actual cannabis there, but in that case, they'll be able to deduct everything. And then across the street or down the street, same owners, that's where they sell the cannabis. And they'll probably usually, oh, well, you need some papers, or you need something else, well, go down the street, and mention us. Then in that case, two separate businesses, then that'll work. But if it's in the same business, then it won't work. Just to give you, even how people were trying to be creative with the, cases with that. People have tried. There was a one even situation, even in California. Um, the Champ case is actually a popular one. Um, there's two situations. There's two actual cases here. There's the Olive case and the Champ case. It's similar fact pattern. They just have they're older cases. They have the way they ruled is actually pretty different. Now, one argued that part of it was like a social, uh, not like a, what would you call it, like group therapy in a way. And to the extent that the group therapy portion of it, it's a portion of it should be attributed to that business. A portion of it, because in that case, the case was actually for medical patients, people that were terminally ill. So some of it was group therapy, and they participated in several activities, and not what the IRS first envisioned. They're just getting high, smoking weed. No, that's not all they were doing. Yes, there was self-medicating, but a lot of it was just different types of activities, yoga, exercising. Again, it was therapy. In that case, the argument could be made that there's two separate activities here. The cannabis side, where they're selling the cannabis side, that's just cost of goods sold. That's all they can deduct. The other business side of it, again, and you got to make a again, facts and circumstances in this case. So long as the facts and circumstance does dictate that there was some group therapy, that it was medical procedures done there, then argument can probably be made that in that case it's two separate businesses. Much better keeping two separate locations. It would be much better. But if you have some type of arrangement like that where it is medical, then you can make an argument. Well, then in that case, well, we're meeting patients too, and we have a separate room that's geared towards people medicating, and not just medicating, and also participating in group therapy. Then in that case, it's again, the thing about that, they ruled differently depending on which case you look at. But if you make a strong argument, to the extent that the group therapy portion of it, the club, so to speak, that's medical, that's a separate business, then yeah, it could be deducted. But generally speaking, it's very hard sell. It's better if you have not just a separate entity. The separate entity helps, but separate location, separate activity altogether, then that would help you out a lot. But if you're just making an argument, then it's different. But yeah, that's the cannabis industry. It's a industry that is growing, pun intended in that case. This time I did mean that. And even with that, the case law is ever changing. But even with the reason why I bring up cost accounting or even managerial accounting, your 182 class, again, just think of you guys already understand what goes into inventory. It's really not a complicated issue. It's just whatever goes into inventory. Think of your production costs, your manufacturing costs. It's pretty as simple as that. However, for code under section, there's treasury regulations in the 471 where some of the indirect selling and administrative costs may be included, so long as it's reasonable basis and so long as it's part of the production process. The term here is production process. It has to be part of the production process. That's what I want you to take away from that, and the reason why I mentioned the cost accounting class side of it, because that's what you need to know. A couple more pages here. Hobby activity deduction, section 83. That's limited to hobby income. Deduction is miscellaneous deduction subject to the 2% AGI floor. Income is reported on line 21, Form 1040, as other income. And it goes on a separate schedule, actually. Now, I forgot I have to update this with the forms. Due to the Tax Cuts and Jobs Act, miscellaneous expenses subject to the 2% AGI floor have been temporarily suspended. So think about this for a second. You have hobby income, that's income. You have hobby expenses, no deduction. Income, you claim it, no deduction. What do you think is happening here? Well, that's generating revenue for the government. The reason why some of these expenses were disallowed is bringing revenue for the government, something to keep in mind. Now, the reason why I bring up Section 183, this is the IRS does have authority to reclassify a business activity if they see net losses in 3 out of the last 5 years. Doesn't have to be consecutive years, but if they see recurring losses, they can say, well, you know what? That's not a business activity. That's a hobby. We're going to reclassify it under Section 183D. the taxpayer has the burden of proof to prove that it's an actual business. Well, how can you prove that it was an actual business? Think about it. Let's say you got challenged. There's losses, and keep in mind, and even it's I guess since we're talking about the cannabis industry, and this is true for any industry, more so in the cannabis industry. I have financial statements on the cannabis industry and on Brightspace if you want to take a look at it. But you're going to see something that's pretty common. Gross profit is positive, net income is negative, but they're still paying taxes based on what I just explained previously. Now, and that issue is they have recurring losses. Can the IRS challenge that and say it's a hobby activity because of the losses? Yes, they have the authority to do so. But think about any other business. Any other business, bars, restaurant, pretty much all businesses. The first couple years, it's common for a business to have loss. So that's an argument you would have to make. What's common in my industry to have a loss? Well, how can you actually argue that you actually have an actual business? Think back to the slide that I just showed you, the entrepreneurial efforts side of it. You got to prove that you actually have a business. How can you prove that you actually have a business? When you start a business, what's the first, among several documentation, what's usually the first thing that you usually do? A business plan, right? You have a business plan that would help you to prove that you actually have a detailed business plan to show that you actually have a business plan. Specifically, your marketing strategy, your marketing plan. You may not be making any sales, but you have a business plan specifically or independently, a marketing plan that would help. How about accounting system? Good accounting records. You have QuickBooks or any other accounting system. You have accounting policies and procedures. You're just not making money. If you have anything that will prove that you're actually running a business, but you just have a loss, that's fine. Again, think about bars, restaurants, a lot of businesses, clubs. They always have losses in the first couple of years, and that doesn't mean that they're not a business. You just got to prove that you actually have a business. All right, production of income deduction. Now, these deductions are again, these are your investment deductions, Section 212 deduction. Now, that's limited to gross income. Now, deduction is a miscellaneous expense deduction subject to the 2% AGI floor. Generally, the income is reported on line 21 of 1040. Due to the Tax Cuts and Jobs Act, miscellaneous expenses subject to the 2% AGI floor has been eliminated. Now, business expenses, now you hire an attorney to recover any uncollectible receivables. Well, that's above the line deduction. You hire an attorney for back rent, that's above the line deduction. If it's related to business, deduction for AGI. Personal is deduction from AGI. So we went over the fact patterns on settlements and recoveries. So I sued somebody for defamation of character. I recovered $150,000. My attorney kept $50,000. So my attorney kept $50,000. I got a check for $100,000, right? How much is income to me? $150,000, the full amount. Even though I only received $100,000, the full amount is income to me, $150,000. Can I take a deduction for $50,000 of attorney fees? Well, let's see. Well, yeah, there's a deduction for production of income. Oh, no. Due to the Tax Cuts and Jobs Act, these deductions have been eliminated. Again, another income revenue generated for the government, so attorney fees. Attorneys had to be very, very careful on how they structure their arrangements. Again, business expenses can be deducted for AGI as above the line deduction. Now, Section 262 of the Internal Revenue Code. Again, this is your. I told you there's no personal expense deduction except when there is. Here are your itemized deductions that are allowed: medical expenses, taxes, interest, charity, casualty theft loss for federal disaster areas only. Gambling losses limited to gambling income. That's it. That's it for itemized deduction. Now, related to just a general overview under Section 165. This is usually how it works. Not always, but this is the general rule. If the business loss is business in nature, the deduction is for AGI. Here are your examples of some. Again, if the loss itself is in business in nature, it's usually for AGI. So sale of a fixed asset, you sell it at a loss, that's for AGI. You have a net loss from your business, that's a deduction for AGI. You may even have a net operating loss, that's a deduction for AGI. If you have a casualty death loss on fixed asset, deduction for AGI, above the line deduction. Now, these are the deductions of non-business losses. Well, here it depends. Keep in mind, the only deductions from AGI are itemized deductions. Everything else is for AGI. So you sell a capital asset, that's for AGI. We talked about that later. Or we talked about it earlier. We'll talk about it later too. Casualty death loss on personal property, again, it has to be a federal disaster area, deduction from AGI, itemized deduction. Gambling loss, deduction from AGI. Again, part of itemized deduction. Now, I threw in a professional gambler case. This is the Grossinger case. I'll talk about more in more detail in this case, but this person had entrepreneurial effort, can only deduct the losses limited to your income. So you're probably thinking taxable income was the same anyway. Well, it was, but taxes were still due. I'll explain that in more detail next week. So this is more of a question: should I put it on Schedule A as an itemized deduction, or put it Schedule C as a business deduction? The professional gambler won. He deducted as a deduction for AGI, as a deduction for AGI, above the line deduction, not as an itemized deduction, still limited to income. Why he won? He had journals. He had the burden of proof to show it was an actual business, so he was running it like a business. He had an accounting ledger, books. He had actual trade journals. He was actually running it like an actual business, even though he wasn't actually making money, but he was running it like an actual business. There are professional gamblers, by the way. If that's their livelihood, then they'll be able to take it as a deduction for AGI. The main argument here was alternative minimum tax. That was a difference. Like $2,000 of alternative minimum tax, just $2,000, went all the way to the Supreme Court. Taxpayer won on this case, just for $2,000 of alternative minimum tax. Just a classification issue. If it's a professional gambler, deduction for AGI. If you have a full-time job, you can't be a professional gambler. Just keep that in mind. Again, I have why do I have these again? These should not be here. Sorry, these two should not be here. That's it for losses. Investigating a business. I'll talk about it right now. I'll revisit this next week as well. Next session. When you investigate a business, some of you may ask, are those expenses deductible? Well, it depends. If it's a new business and you started the new business, again, you got to start the new business, and it's a new business, it's considered a startup expense. And these are the startup expenses are deducted. You deduct the first $5,000, and then you amortize the rest over 180 months. Then it gets to phase out when the expenses exceed $50,000, dollar for dollar. It completely phases out when it exceeds $55,000. I'll get into specific examples on this next week. Right now, I just want you to know that it's a startup expense. If you started a new business and it's a new business. What if it's an existing business? Again, the first one, it's a new business. I started up a CPA firm, then it's a new business, my first time starting the CPA firm, startup expenses, right? What if it's an existing business? Let's say I'm paying somebody to look into buying a new business or a new book of business, a new CPA firm. It doesn't matter if I started the new venture or not, it's still an ordinary and necessary business, so long as it's in the same business. Again, let's say I'm trying to buy a new practice, a new book of business. I hire a consulting or a marketing firm or broker to look for a book of business for me to buy. Again, doesn't matter if I get the new business or not, it's deductible because it's still my line of business. So what happens, and this is just common sense, so what happens if it's a new business and I did not start the new business? Well, you don't get a deduction. Generally speaking, you don't get a deduction for that because you did not start the new business. In order for it to be a business venture, you actually have to start the new business. Now, the other question related to deductions, something to think about. Um, Again, no deduction for personal expenses, section 262, exception for itemized deduction and personal tax credits. We talked about that. Section 263, that's a common code that's cited a lot. That tells you capital expenditures are not deductible. Again, think about this just accounting standpoint. Inventory. Can you deduct inventory, or better yet, accounting concept? Can you expense inventory when you buy it? No. When do you expense inventory? When you sell it, right? Same thing here. It's capitalized to inventory and you expense it when you sell it. Again, think of accounting concept. When you buy a fixed asset, do you deduct the cost of a fixed asset when you buy it? No. How do you recover the cost of the fixed asset? You depreciate it. Same thing here. Same thing for intangible assets. So same thing for accounting. These are your capital expenditures. You capitalize it as an asset until an event happens. So, and then for inventory, the event has to be that you actually sell it. For fixed assets, where you put it in operations, you depreciate it. For intangibles, you amortize it. It has to be amortized. Now, Section 265, you probably may hear this a lot. No deduction available for funds excluded from gross income. So here's the part that I'm thinking of. Under current tax law, there's no guidance right now. So some of you probably heard about the PPP, the loans, the grants, and coronavirus aids. Some of these loans are forgiven, right? Now, if a loan is forgiven, should it be considered income? Well, actually, Section 108 hasn't been updated, so they should be update that to include that. But just on, let's say if you're able to exclude the forgiven income, can you take a deduction on the same amount that you're excluding? No. That's under Section 265. Again, double benefit rule. Again, let's say, I have a loan, and that loan, same year, gets canceled, and I'm excluding the loan because it got canceled, and I meet the criteria. I'm excluding the income. That's tax-free money. I can't later on take a deduction for the same amount of that I excluded it for. It's a double benefit. That's under Section 265. Very common right now with the payroll protection plans and SBA loans. Again, to the extent that is forgiven, any forgiven debt that's excluded, you can't get a benefit from the same tax-free sources. Again, tax benefit rule. Related party losses, you sell somebody something at a loss to a related party, you cannot take a deduction. And this one, I really want you to think about this. If you pay somebody else's bills, you cannot take that as a deduction. So you pay somebody's real estate taxes, you pay your mom's real estate taxes. You cannot take your mom's real estate taxes. The person obligated to pay it should take the deduction. That's all that I have for, no, actually, no, I don't. Home office, the deduction. I don't think we're going to get into home office yet. Qualified business income deduction, we're not going to get into this yet. Actually, let's talk a little bit about the home office, just enough for you guys to understand. Home office, this is how home office is determined. I mean, home office, the same section. A vacation home. A vacation home is when the personal days, again, those are the days that you use it for personal purposes, are greater than 10% of rental days and greater than 14. Again, the personal days have to be greater than 10% of your rental days and greater than 14. So here are the rules for vacation home. So rented less than 15 days. We already went over that before, right? It's excluded from gross income. Expenses are treated as personal. The only thing that you can deduct is mortgage interest and property taxes. What happens if it's rented for 15 days or more? The tax preparer needs to determine if a vacation home or if a rental property. Now, here's the vacation home test. Now, what I have here is just, if you think about it, is this in a nutshell. Vacation home is more than, when personal days is more than 10% of rental days and greater than 14. So first you have to determine the personal days. Then you have to figure out your rental days, multiply that by 10%. Is your personal days 1 greater than 2, 10% of your rental days, and is 1 also greater than 14, you have a vacation home. What if it's no? Then you have a rental property. So that's how it works. So how do the expenses work? Expenses for vacation home are limited to gross income from the rental, from the vacation home. Deductions for AGI, by the way, but the expenses are limited to income. Expenses are split into 3 different categories. They have to be done in this order: mortgage, interest, and property taxes first, other expenses, then depreciation. There's 2 ways of allocating those expenses. You can use the tax court method or the IRS method. The tax court method does favor the taxpayer. The IRS method favors the IRS. I'll go over those methods in more detail later. Tax deductions are deductions for AGI, but are limited to rental income. See below. Again, it still goes on Schedule E. Expenses allocated to the vacation home, but are not allowed to gross income limitation. You cannot have a net loss on a vacation home. It's limited to gross income. But if you have some expenses that are limited, those expenses are carried forward until next year. Again, you cannot deduct loss on a vacation home. Expenses that are not, I'm going to repost this. Expenses that are not allocated to the vacation home are treated as personal. So again, you got whatever's allocated to the vacation home, that's one. Whatever's not the vacation home is personal. Remember, only mortgage, interest, and real estate taxes on personal use property are deductible. Hence, only deductible portion is from category 1. You go to category 1, the only deductible portion attributable to the personal portion is line 1. Again, you're still deducting whatever attributable to the vacation portion, limited to gross income. But what's deductible as an itemized deduction is just the mortgage, interest, and real estate taxes. Remember, other expenses and depreciation are not deductible. Now, here are the methods that we're going to allocate we're going to go over this in more detail later. Days rented, that goes on top for all of them. Now, total used days, that's the sum of your rented days and your personal days. Again, total used days is the sum of your rented days and your personal days. Now, it's the same thing for the IRS method for each category. Now, for the US tax court method, the only thing that's different is the first category. Under the first category, what you're allocating to the vacation home is the ratio of rented days over 365. So you're allocating less to the vacation home and more to personal. Let me say this again. You're allocating less to the vacation home, more to the personal portion. I'll say it again. You're allocating less to the vacation portion, more to the personal portion. You're maximizing on your itemized deduction. You're maximizing on your mortgage, interest, and property taxes. That's what you're doing here. The IRS method doesn't like it. We'll go over both methods in more detail later. Now, the qualified business income deduction, in more detail later. Take a look at it. We'll cover that after self-employment taxes, but I want you to at least get an introduction of it. This is up to chapter 6. We're not going to do qualified business income deduction yet. We'll wait till self-employment. That's chapter 9. But at least, I want you to take a look at it. One more thing before I open it up for questions. There was another. I posted the other virtual notes for what's the next section? Business. Now, one thing I want to share with you for business losses. All right, so this is the business expenses and losses. Take a look at this at your own. A lot of this is repetitive. Again, this is not as extensive as what we just covered. Where's the section? Oh, here it is. Here. Now this is still there. No, wait, where is it? No, this isn't it. Sorry, this is not it. Number 6. Then get the chance to look at the entity table, but all right, with this one again, take a look at this. Pretty straightforward. But what I want to direct your attention, this particular section. Again, this was passed as part of the Tax Cuts and Jobs Act, and I was not being funny when I was typing this. This is what the book has, and I want to bring something to your attention. The whole point of this is just the limitation on losses, on business losses, which was actually, again, on theory, it made sense. It was preventing individuals from creating tax shelters. So the excess business losses that were allowed, there was thresholds in there, up to this the 259,000, 518,000, or 250, or and 500,000 for previous year. Again, I was not trying to be funny with this particular section. Again, this is not going to be in the book, but as part of the this particular section, as part of the CARES Act that was passed, this provision, this whole section on excess business losses has been repealed, not temporarily repealed, repealed completely. Remember, this is one of those provisions that was, and the intent was to generate revenue for the government. What do you think is going to happen in this case? A lot of people are going to claim losses, which is great. Part of the reason why they repealed it, and a lot of businesses are suffering losses right now, so they should be allowed to get increase their cash flow because of it. I have a problem with it because it's been repealed permanently. It's not a temporary provision. Other stuff regarding temporary provisions, when you look at the net operating losses, those were temporary provisions and temporary relief. But just on this alone, there's a lot of it's a lot of room for abuse in this particular case. A lot of room for tax evasion, possibly. Definitely abuse and tax shelters. A lot of people are going to take advantage of this code section, and it's not going to generate any revenue. I say that to say this. Some of you may probably have read some articles about how the CARES Act opened up loopholes for rich individuals. Not necessarily true. What they're trying to actually make you understand is these type of provisions that are still there, that not rich, not wealthy individuals, but any individuals that have business activity can again benefit from. Can the wealthy benefit from it more? Perhaps the wealthy can benefit from it more, so long as they have business activity. Again, it does create a lot of opportunity for abuse. And don't be surprised if you read articles about it. And it's not that it's the articles are inaccurate. They are accurate, but because of this, the provision has been eliminated. And there's a couple other provisions that have been, geared towards helping out businesses. I don't know what I think about it yet, because I do agree that the CARES Act was there to help out businesses. I just have a problem with it being repealed, this particular provision being repealed, permanently. Because again, the whole point of this was let's cap it at the losses individuals can take. And also the other side of it is non-corporate taxpayers. That's all that I have, for today. Any questions? I'm going to open it up for any questions today.
Yeah, I have a question going back to the hobby activity deductions. So this is about the IRS reclassifying business activity if such an activity has 3 losses in a 5-year window,
Okay.
according to section 183, lowercase d. Um, Now, when they reclassify stuff, does that affect the previous years or only the current
Yeah.
year filing?
No, when something like this, it does. They do it in multiple years, so it's going to be the years that they're auditing. And something like this. By the way, I'm actually glad that you asked the question. Something like this will probably be common when, let's say, they pick 2018 return. Well, let's say they're auditing 2 years: 2018 return and 2017 return. They found losses in both years. Well, wait a minute. Let's pick up 2016 return. Let's pick up 2015 return as well. It's to the extent that it's within the window. And then they're going to see a pattern. Then if there's nothing but losses each year, then they're going to be like, well, wait a minute, we're going to say this is a hobby. Again, the taxpayer will have the responsibility, the burden of proof to prove that it wasn't, a hobby, that it was an actual business activity. But yeah, they will go after multiple years. So something like this, and not just it's going to be in essence the 3 years that they're questioning. At the minimum, it's going to be the 3 years that they're questioning that they're going to make an adjustment on those 3 years, not the current year. But it may be driven on the current year's activity, or 2 years activity. But it's going to be the years that they're actually investigating. That's how that would work. Any other questions on that? But again, the expenses are not deductible right now because that whole line item has been eliminated. No question. Any other questions? No questions. So again, next session, we may not get into chapter 7 yet next week, but I do want to get into some of the hobby activities. So next session, we'll do the quiz. So make sure you do the quiz tomorrow or Wednesday before class. We'll review the quiz. Then we're going to do some problems. We're going to review some of this stuff from chapter 6, but we're going to do chapter 4, 5, and 6 next session, possibly even towards Monday class, perhaps. There is a problem in chapter 3, that problem that I want you to take a look at. We'll do that problem next session as well. That problem, chapter 3, I think is 52, if I'm not mistaken. But that's something I want you guys to take a look at. Any other questions? Again, your midterm is coming soon, like very, very soon, in a couple of weeks. So start thinking about that. As we get closer to the midterm, I'll give you more of an idea of what I'm going to ask you. So just so you have an idea, right now it's going to be like 6 short answers, 1 big problem. So again, the big problem is going to be like a case scenario. You have to walk through the whole tax computation, figure out what's gross income, the exemptions, filing status, all that. That's going to be part of your problem. So that's going to be like 40 points, so 40% of your grade, depending on how I weigh. That's going to be 30 to 40 points. Let's say 40 points of your grade. The other short answer questions, just so you have an idea of what to start, covering. There's going to be a question where I ask, what's the filing status and the dependents and related credits. So $500 credit, $2,000 credit. That's going to be one question. Again, this is on the midterm, by the way. I may ask you on the legislative process, the judicial system. I may ask you on that. Vacation home is going to be a question on the vacation home. So far, that's all that I'm going to tell you right now. That way you can get at least an idea of what to study. Again, vacation home, the legislative process, the judicial system, primary sources of tax law, and then that filing status and dependency test, and then that big problem. Again, I'll give you more detail as we get closer to the final. But again, we'll give you some guidance in terms of what I'm going to test you on. But again, you will have a practice quiz session before the final. I guess use that as a review. Any other questions? No questions? Any thoughts, comments? Anything you want to share? Something that happened in your life related to tax, not related to tax?
I did actually get audio for today's meeting, so if anyone's looking, you guys can find this on YouTube in a day or two.
Thank you. Oh yeah, about so you weren't able to get audio last session?
Yeah, I switched headphones and it was picking up from what my old headphones would have been, so they had no audio.
Oh no.
Had audio, which I can fix it then, but unless someone recorded it, I can't do anything with it.
Did you also get video from today's lecture?
Yes, I did get video from today's lecture.
Oh, great. Okay. Thanks.
Do me a favor, Matthew. Can you send me an email? What's the app that you use? I'm curious to know how do you record it. I know I can do it on the cloud here. I just got to set it up. But how do you...
using the Twitch streaming app. They have an option to record video with it, and then I use a video editing software to adjust the audio.
Oh, okay. Oh, okay. Oh, okay.
Yeah, they're surprising. Twitch, they're pretty good, pretty robust. You know, a lot of people use it for games. So
All right. Well, thanks for doing that. I appreciate it. Well, I'm sure the class appreciates it. Any other questions? No questions? Yeah, and I'm gonna expect everybody to participate next session, next couple of sessions. So make sure you do the homework. Start taking a look at the additional the problems, the additional classroom problems. We'll do the vacation home and maybe the net operating loss before the midterm, but definitely the vacation home. We'll do that one. There's a couple other problems as well. Something else I wanted to mention to you, I posted all the subsequent slides or lecture notes, I should say. I already had them from last semester. So just give you some background. Last semester, right after midterm, right in March, actually, that's when we switched over to virtual. So before, if you can believe this, this is my notes. If you guys can see it, can you guys see this? My notes. These are my notes. Can you guys see? That's how I had my notes before. On pieces of paper. And what I did before, I would actually write them down, and students would write down the notes as I'm writing them on the board. You had the benefit of it being switching over to virtual. It forced me to type up my notes, which I guess it was a learning process too. I typed up my notes. So the notes that I had, I already typed up the notes from after midterm, like a lot of the deductions and property transaction and tax credits. Those were already typed up. So that's why I was able to post all the rest of the lecture notes, right away. I just typed up I caught up to everything today, and then I just updated the ones I had last year or last semester, I should say. So you're good to go. The lecture notes are there. The PowerPoint slides are there. Hope all that helps you in preparing for the class and reviewing the material. Any other questions? Any comments? Nothing? All right. On that note, I need somebody to make a motion to adjourn and second.
Motion.
Second. All right. Thanks, guys. I'll see you guys next session. Good luck. Enjoy studying tech. See you guys.
Bye,
Thank you.
guys. Thank you.
And
Yeah,
goodbye.